of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
The real issue is we need to do more. We have not seen inflation move back down, and we need to see that because leaving inflation where it is, if it continues, there's a higher chance that it does become embedded in the economy.
Loretta Mester there, the Cleveland Fed president. That lady is not for turning anytime soon on hiking interest rates, it seems. Live from New York City this morning. Good morning. Here's the price action. Equities bouncing back from 5 days of losses on the S&P, up 0.5%. Yields just a little bit higher by a basis point or two on a 10-year in the US at 396.37. In the UK, yields a whole lot higher on a 30-year, up by 20 basis points to 4.98. You see this headline from earlier this morning. The Japanese 10-year, Lisa, the bond hasn't traded for 4 days. For the first time since 1999. Talking about a broken market in the UK. Can we talk about just a broken mess over in Japan? It's not even a market. How many times have we said that?
It's not a market. So where you're seeing the relief valve is in the yen, and you saw the yen actually weaken to levels that were beyond where we had seen when they actually did intervention. So at what point does this mean new intervention? At what point does this mean the Japanese authorities have to more aggressively liquidate their FX reserves at a time when they're planning for a pretty long haul, it seems?
Oh, what a crazy time. Rick Reeder said it was a crazy time. Mohammed said he's never seen anything like this before either. Truly historic. Joining us from D.C. on what is shaping up to be an historic week, Tom Keene. You've got a special guest for us.
Well, John, it's going to be very interesting. If you remember yesterday afternoon, and here's the headline buried in the news flow, the Bank of England Governor Andrew Bailey. This is at the IIF annual membership meeting yesterday in conversation with Tim Adams, the President and Chief Executive Officer of the Institute of International Finance. And we begin today's coverage in Washington with Mr. Adams, with his deep experience with the Bush administration and with international economics, certainly, Tim, in time of crisis. So thank you so much for starting our day strong. We've got Axel Weber coming up as well, much more on Europe and that. What was it like yesterday when Governor Bailey reset the global debate?
Well, thanks, Tom. It's always a pleasure to be with you. Thank you for having me. You know, look, I think we're hearing from Governor Bailey and others. We'll have Kuroda and Christine Lagarde today. They're serious. They're serious about taking the punch bowl away. It's time to reverse the policies we've seen over the past 7 to 8 years. It's time to move on to a new normal. And I think Andrew said he's ready to get on with it.
Stanley Fischer, 5 years ago, 6 years ago, talked of ultra accommodative. We clearly moved through accommodative. We're trying to search for neutrality. And even some of these bankers desire a restrictive state. Does that put out the zombie companies? Is the final result of all of this movement that we eliminate the zombie companies and indeed, I say, the zombie banks of which you represent?
Yeah, well, I don't represent zombie banks. The banks are in good shape. But yes, the zombie companies are going to go away, and they should. This is creative destruction. This is the way cycles work. And for far too long, we've had cheap liquidity, an abundant amount of liquidity, and we funded a lot of firms, a lot of sectors that probably shouldn't be in business. We need to redeploy those resources, those assets, in more productive ways.
You sat on the political side of this debate serving the younger President Bush. Would you suggest the politicians have power here, or a renewed power with British yields out at 5%, with yen at 146? What's the power of politicians this morning?
Well, the politicians want it both ways. They want to get rid of inflation as quickly as possible because they see it every day, gasoline prices, for example, but they want to do it in a painless way. They want to do it in a way that doesn't create disruption. That's very difficult to do. Central bankers have probably the toughest job they've ever had right now.
Okay, I'll go with that. But Secretary Geithner, 15 years ago, 17 years ago, would say the solution is to extend the timeline. Why are we in such a hurry to bury the economy into a global recession? What's the race here?
Yeah, I think there's a sense of catch-up, that they waited too long.
Granted.
And so they want to make up. I think some of it is just bringing back the reputation of the institutions. There's a concern that maybe the Fed or other institutions have lost some of the reputation as being tough. I think Jay wants to prove a point. And I think you heard from Andrew yesterday, he wants to prove a point too.
Can they stop and pause?
They can. I don't know that they will. It depends on what they might see. Obviously, there's a lot of turmoil around the world. War in the continent of Europe, gasoline prices, as we see from OPEC. I think they're pretty adamant about moving ahead.
I must turn to banking. Of course, the great mystery, and this goes back to Fortis of Belgium years ago, which is where in Europe there were transactions and combinations across borders. That's always a challenging thing. With the challenges at a selected Swiss bank, do you look for transactions and combinations within the members of the Institute of International Finance?
We do, and risk assessment's an important part of what we do here. That's why we have a board of 50 institutions that encompass the world. So we constantly talk about risk. Our board meeting tomorrow will be a conversation about where do we see weaknesses in the system and how do our institutions communicate with each other.
Okay, I'll go with that, but the reality is selected regions' book values of banking are, to use an American phrase, flat on their back.
Yeah.
What is the urgency right now to pick a region within European banking?
Well, we know book-to-value ratios in Europe are pretty soft. But Europe needs something different than just monetary policy. They need consolidation. You have 4,000 institutions across
Exactly.
Europe. And so
How
we
can
need
you affect
consolidation.
that?
And, well, you need Brussels and capitals to act. We need a consolidated capital market, which benefits U.S. firms here. We have the largest capital market in the U.S., which helps the J.P. Morgans and Bank of Americas, which we'll hear from today and tomorrow here. But Europe needs banking consolidation, and you need capital market union.
You are steeped in Washington and in the politics of a traditional Republican Party, which some people would say has gone the way of a fossil. In that, what does the Biden administration need to do to solidify American leadership other than to generate a strong dollar?
Well, we need to deal with energy, and I think they've tried to do it both ways. One is to talk about a climate transition, which we should, but in the near term, we've got to find ways to produce more oil and get it piped to the place it needs to be. We need to address near-term security and affordability concerns.
Are you going to make headlines today like you did with Governor Bailey yesterday? Is it a redux here with Lagarde? Come on.
We are indeed. Stick around. It's going to be a big day.
Tim Adams, thank you so much. With the Institute of International Finance, John, and I'll tell you, if he can do back-to-back, John, with Christine Lagarde, what he did with Andrew Bailey yesterday, John, our jobs are a threat.
Hey, TK, thank you. Great work down in Washington. To Tom's point, President Lagarde and Governor Bailey, what have they got in common? I was thinking back to those comments in early 2020. We're not here to close spreads. Yeah. President Lagarde, did you get the same feel from Governor Bailey yesterday? You got 3 days.
I saw you put that out on Twitter, and I figured that you were basically highly skeptical that really some of these pensions...
Just reminded me of that moment.
Where that basically they're not going to be able, the Bank of England's not going to be able to hold firm to something that is triggering financial stability so significantly, and so they'll have to eat their words and then threaten to undermine their credibility. That said, this is a different scenario for one reason, and that is simply inflation. And as you get inflation continuing to creep up, it becomes increasingly difficult, and the rock and the hard place is very much in four, with the UK poised for its second monthly contraction in 3 months. And so, at what point are they forced to accept higher inflation for longer?
And Tom asked a good question. What's the appropriate time horizon to get inflation back down towards target? They're worried about the 70s and the prospect of a flip-flop, that they back away too early and then have to go hard again. And it's got messy quickly. How many times have I used that word this morning in 1 hour?
Well, it is incredibly messy. Front-loading, I think, is being called into question. Do you front-load or do you go gradual?
Banks aren't zombies. Remember that?
Is that your takeaway?
Some pushback, wasn't it?
Not the ones that he oversees.
From New York City, this is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. And the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
The question is, does the Fed blink? I don't think it will.
How do you explain to markets and the public that you still have resolve in fighting inflation if you're slowing down rate hikes?
Instead, inflation got out of control, and now they need to really get it under control, which is going to be a process.
The Fed have got a domestically focused mandate.
Market functioning problem in the U.S., we haven't really seen it, especially when we compare it to what's happening in the U.K.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Here in New York, alongside Lisa Abramowitz, I'm Jonathan Farrow. Equity futures positive this morning. That wasn't the story yesterday. New lows for 2022 on the S&P 500. New highs for a 2-year yield in yesterday's session.
And concern about contagion, concerns about financial instability, concerns about this question of, is the market going through the windshield, in Mohamed El-Erian's terms, at a time when the Fed and central banks around the world are slamming on the brakes at a speed that we have never seen before.
And then kind of stepping back in simultaneously at the same time.
Maybe.
To pick up on another Mohammed analogy about actually driving a car, he said a number of weeks ago it was like putting the accelerator down and putting the brake down simultaneously. And what happens? The smoke coming out of the engine. The smoke coming out of the engine right now, 30-year gilt yield up 18 basis points this morning.
I just have to say I hate that kind of driving. And I've got to say I always feel sick. And so is this market. And that's the fear, is
Precisely.
that right now you cannot have your cake and eat it too. And that is the conclusion from a central bank in England that tried to both ameliorate financial stability concerns while still grappling with the highest inflation in decades. But to me, the big takeaway is the signs of contagion, the signs that this is not isolated simply to the United Kingdom, that there are similar signs of this type of trading in other markets as well, including in the ECB, where they're going to have to deal with the Italian, with the Spanish, with the Greek yields.
Can you believe it's only Wednesday?
No.
I was doing that yesterday. I was going through the price action yesterday. I was like, it's Tuesday evening. What is going on? I thought it was Wednesday yesterday.
And guess what? Earnings start on Friday.
I know, and CPI tomorrow.
There you go.
As well. There's a lot to get through. Let's whip through the price action for you and start with the S&P 500. Trying to bounce back from a 5-day losing streak on the S&P. We're up by 22 points, advancing 0.6%. Yields are basically unchanged on a 10-year, 395.55 on 10s. In the FX market, the euro just a touch stronger, 97.17. At least the euro dollar positive a 1/10%.
All right, today we're looking at PPI, which is the prices that factory producers are paying. We're expecting that to come in just a bit, and we have seen that come in gradually over time. This comes at 8:30 a.m. Will it matter? Not nearly as much as CPI, but perhaps we'll get some tea leaves about the direction of whether things are cooperating or not with what the Fed would like to see. At 1 p.m., the U.S. is planning to sell $32 billion of 10-year notes. This, to me, may be one of the most interesting aspects of the day, and I say this as a lot of the big investors pull back, whether it's Japanese pensions, whether it's people in the United Kingdom who are trying to liquidate assets in order to plug a certain deficits. All of these sellers at a time when there is a question about inflation and you're seeing real yields climb to the highest levels going back to 2010. And then at 2 p.m., we do get the meeting minutes from the Fed's prior meeting. How much do they speak about the duality of risks here, right? This question of the risk of moving too quickly before the lag effects go into place, plus the risk of letting inflation become a 1970s entrenched, unmoored kind of feeling. We're also going to get, of course, Fed speak because it is another day on the week, and that includes Neil Kashkari, Michael Barr, and Michelle Bowman. Do they really reiterate a slight shift in tone that we heard from Lael Brainard, emphasizing this other risk of perhaps moving in a way where you don't fully understand the consequences until 6 months later?
Have we got another week of this before the quiet period?
Are you counting down to the quiet period? Is that really what we're doing?
Come on, it's absolutely ridiculous.
You know, it's who matters. That really is what it comes down to.
I'm with you.
And at this point, Chair Powell, but also Lael Brainard, is it really giving some influence, or is this basically, at this point, just adding to the confusion?
Tom Keene's down for us down in Washington, D.C. TK, the IMF yesterday, I think the message was clear. The worst is yet to come. How bad is it?
How bad is it is 2008. This is without question, John, the most extraordinary IMF meeting, the most important one since early 2008. And I can only say that the international data points overwhelm anything going on in the United States. You're going to go to Guy Johnson here on what we see in London, 5% yields, and the yen out to a 146 is one of those little tea leaves in the wind of what these meetings are going to say in the next 3 days. John, we will speak with Axel Weber of the Bundesbank and UBS in this hour.
And you're going to be speaking to a central banker from the current ECB as well, Tom. I just wonder what their decision looks like at the end of this month.
I think the ECB is front and center, John. As you mentioned, this is Tim Adams moments ago making news with Governor Bailey yesterday here at the IIF in the Reagan Building in Washington. He's going to do the same thing today with Lagarde. Explain to me the degrees of freedom that Madame Lagarde has lost in the last 2 weeks.
They're looking for a 75 basis point hike, Lisa, on October 27th. 75 basis points. They've got an inflation problem, we know that. But at the same time, they were the first to come out with a permanent mechanism to deal with potential financial instability off the back of rate hikes, TPI. TPI, what does TPI mean? Transmission Protection Instrument, something like that.
I just listen
the
to these things.
anti-fragmentation tool.
Okay, well, where are spreads now? Take a look where those Italian yields are right now.
3.50 earlier this week.
Yes, and right now what you're seeing are Italian yields at the highest levels going back to 2013, continuing to climb on the heels of some of the disruption over in the United Kingdom, perhaps. I mean, if you want to make that connection. What do they do? When do they step in? When do they have to use it? This is not a tool they want to have to use.
Hey, Tom, looking forward to the conversations later this hour. Looking forward to your coverage through the whole of this week. Tom Keene there, down in Washington, D.C. Over in London, Bloomberg's Guy Johnson joins us now. Guy, PMQs, they're back.
They are, and the Prime Minister is on her feet speaking right now. Her government is, quote, making sure we protect our economy. I will pause for a moment and think about the implications of that. If this is what protecting your economy looks like, I wonder what playing fast and loose with it ultimately does. It is a challenging environment, let's say, for the Prime Minister right now. I suspect this is going to be a fairly feisty Prime Minister's questions.
Equally challenging, Guy, for the Governor of the Bank of England as well. I want you to frame the importance of his comments yesterday. We always knew the line in the sand was October 14th. What was special about what he had to say yesterday in Washington?
It was a reiteration, but a lot of people are making claims that it was a communications error. And I can see the reason for that in as much as he has once again put himself in a position where he gives himself very little flexibility. And I think that's where the issue lies. There is also this FT report, which was floating about this morning, talking about the fact that behind closed doors, bank officials have been talking about the potential for the extension of the scheme. Now, I don't know the veracity of that report. I don't know what meetings were held and what was said. But if that is the case, then that obviously is doublespeak, and that is not tenable.
But Guy,
so yeah, okay, Lisa.
No, I guess I'm struggling with this one because let's say there were some back office discussions about the potential for an extension. Why wasn't there a more concerted effort on the part of fund managers to offload the potential leverage positions that were causing the problems in the first place?
I think there have been, and I think there has been effort clearly to raise collateral ahead of the Friday deadline. The Bank of England, the way the Bank of England's structured this whole process is very different to QE. With QE, they were price agnostic. Here, and they would buy as much as you wanted. Here, they're not. Here, they're basically trying to manage the process. This is about a rate of change, not the rate. They're trying to slow the rate of change and avoid the turmoil, but they acknowledge that ultimately rates have to go higher. So they're not trying to bring rates down. So that has made this a less useful product for the markets than originally I think was conceived when it was first announced. And as a result of which you got this kind of huge round trip. You go from 5 down to 4, and we're kind of back up to 5 again in terms of what the 30-year is in terms of the yield. And I think it's taken a few days for the market to kind of get its arms around all of this. But this is not carte blanche. This is not the Bank of England buying everything you want to sell them. They'll buy it, and they are being choosy on what they're buying, but they're not buying everything. And there have been days when they haven't bought anything. And I think it's been a less useful product. And basically what Bailey's been signaling is, get your house in order. You're running out of time. But every time that is reiterated, I think it just reinforces the idea that there is still a long way to go. Maybe not as much has been as unwound, because the market was looking for more time ultimately, and that is now not going to be delivered. That's a very long way of putting all this.
John,
but I think it's huge amounts of confusion.
John, I got to say, I feel for Guy as he tries to parse through this.
It's difficult.
This is because basically this is him trying to explain a policy that at its core is a paradox, both addressing financial stability, allowing some sort of easing, unwinding of positions that are untenable in the current regime, while also fighting inflation using very similar types of tools in terms of raising rates. It is mind-spinning.
I can see why they're very, very sensitive about the concept of fiscal dominance right now. I can see why they are. Almost immediately, the questions were asked at the Bank of England, will they accommodate what this government is going to do? And when they first came up with the gilt market operation, they were accused of just that, pandering, accommodating what fiscal policymakers had decided to do. So I think it's really, really difficult for them to do now. And I think that's why we're seeing the kind of language, the approach that we've seen from Governor Bailey. That's my guess. I can't get inside his head. The sense I get from him and the way he spoke yesterday just sounded like a man who was very, very sensitive to the idea that they might be contributing to so-called fiscal dominance.
There is an argument that for decades, central banks helped offset a lack of action from fiscal policymakers, a lack of action from Washington, D.C.
For a decade.
Over the parliament. And this is a question now of, can the central banks pull back and stop giving the fiscal policymakers a pass and risk financial instability and risk perhaps disrupting things to such an extent that imperils the basic functionings of a capitalistic society. And this is going to become an increasing debate in the months to come.
There's something else is going on here, and I don't think is talked about enough. The Bank of England has got a gilt market operation of a certain size, and they can't find the sellers. So no one wants to monetize the losses in the gilt market, and I wonder why that's not being talked about more. It seems to be big enough. They just can't seem to be able to buy enough.
Well,
have you got a why that's not happening?
Well, I mean, that's basically what Guy was saying in a much more diplomatic way.
Sure.
That it wasn't unlimited, that this isn't to cap bond yield, so nobody's going to really necessarily sell into it if they're going to have to solidify losses that are punitive.
The Guy Johnson over in London, one of the best, good friend of mine, good friend of ours, good friend of this show's. Equities, positive 6 or 7 tenths of 1%, live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. NATO defense chiefs are meeting in Brussels today to discuss how to better protect critical infrastructure, ramp up weapon production, and maintain support for Ukraine.
Russia knows that the nuclear war cannot be won, must never be fought. And we are, of course, also closely monitoring the Russian nuclear posture. We haven't seen any changes in the nuclear posture of Russia, but we will remain vigilant.
Meanwhile, the U.S. is speeding up shipment of 2 advanced air defense systems to Ukraine in response to pleas by President Volodymyr Zelensky for partners to supply more weaponry in the fight against Russia. Polish authorities say they believe a leak in a pipeline bringing Russian oil to Europe is probably an accident. Poland's top official in charge of strategic energy infrastructure says he has no reason to assume it was an act of sabotage. Pipeline operator Pern says it expects to know the potential causes in just a few hours. European authorities are on high alert for any signs of sabotage on energy infrastructure since the destruction of the Nord Stream gas pipelines last month. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with their head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Lini Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
The difficulty of balancing growth, inflation, and financial stability. It is not just a Bank of England issue. You'll see it in the Eurozone, you'll see it in the US. It's a difficult trinity. It's not an impossible trinity, it's a difficult trinity. And the later you leave it, which is why the Fed being so late is problematic, the later you leave it, the harder it gets.
And it's hard right now. Fantastic to catch up with Mohammed Al-Arian just yesterday on this programme for a whole hour. The UK very much in focus. Equity futures on the S&P 500 trying to bounce back on the S&P from 5 days of losses and a new intraday 2022 low on the S&P yesterday, up 0.6% now. Yields higher by a basis point on a 10-year, 395.96. Prime Minister's questions in the UK, they're back. Imagine theatrics over in London right now, Lisa. Liz Truss, the Prime Minister, says she's not planning on public spending reductions. And I do wonder where that leaves this little budget announcement we get at the end of this month, this fiscal announcement. If they're not going to get spending reductions, are the tax cuts still going ahead?
Well, yeah, they're actually suggesting that perhaps they'll mitigate some of the tax cuts or not actually make them as deep as expected. But you're right. At some point, the equation isn't working. You're seeing that in the pound. You're seeing that in the gilt market. You're seeing foreigners flee the market. At what point does Liz Truss's administration have to take notice?
Yields up 18 basis points, 4.95 on 30s. The Bank of England's taking notice.
God, I
Big
feel
time.
for them.
It's tough, eh?
I feel for them. I mean, I don't want to feel like I've got sympathy, but at the same time, they're between a rock and a hard place. We've been saying it all morning. It's become cliche. But how do they manage financial stability with an unstable fiscal picture with few details?
Are they making it harder for themselves? Yes, they're between a rock and a hard place, but do you think they're making it hard for themselves?
By interfering at all? But they should just let the market collapse? I mean, what do they do? It's hard to know, and it's hard to know.
Not offering a permanent facility, a permanent gilt market operation. Are we going to end up there anyway? Something that sits on the long end.
They were
helps
hoping
pensions get out of this mess.
They were hoping that it would not come to that, because it is an incredibly messy message to say we're doing quantitative easing and we're going to raise rates, and it is an incredibly messy consequence on the market. However, if that's the consequence, do they get a reduction in inflation, or are yields going to be permanently higher for longer?
Is messy the word of this morning? Maybe the word of this year. Anastasia Amoroso joins us now to make sense of the mess, the chief investment strategist at iCapital. Anastasia, we all field this question, and I'll ask this question of you. What does it mean for me, sitting here in the United States, allocated to US capital markets, with this mess playing out in the UK?
Well, I think it's a big warning sign and it's a red flag, and we should not just assume just because we're not in the United States, we're immune from it. I mean, if you think about what's happened over the last 14 years, you had virtually zero interest rates around the world. And that means that certain leverage accumulated certain places. And it's not on the corporate side per se, it's not on the consumer side per se, but leverage has accumulated on the government balance sheets. If you think about the United States and the fact that we were running a $2.7 trillion budget deficit last year, and the Fed was responsible for essentially financing a third of that. Well, now, luckily, we're reducing our budget deficits and we're on track for $1 trillion or so in budget deficit. But there's no Fed. There's foreign buyers. They're increasingly stepping back. There's banks that are not as involved. So I think this is a real risk that we should think through in the U.S. as well. What happens when we were financing our debt at 1.4%, give or take, and now what happens when some of that debt service has to reset and be done at 4%? So I'm not saying that we follow suit in what happens in the UK, but clearly fiscal policymakers have to be extra careful about how they manage budget deficits when rates are rising.
And I was looking at a Bloomberg economic study yesterday to exactly that point, Anastasia, basically pointing at how much higher as a proportion of GDP interest expenses will be for developed worlds around the globe simply because of this regime and because there isn't the same kind of fiscal constraint embedded in a lot of these communities. At what point have stock investors in the U.S. appreciated this lack of a fiscal impulse?
I don't think we're quite there yet, Lisa. I mean, what we've grappled with is the fact that, these resetting higher of interest rates is going to depress multiples. And that's what the bulk of this year has been about. But I think now, if anybody's paying attention to it or anybody paying attention cannot deny that we now have a set of circumstances that clearly point to a recession, whether it's a mild one or a severe one or something like that. But you look at interest rates across the world. You look at yield curves across the world. You look at demand expectations and things like new orders and new business that is severely coming down. You really can't deny that this is a recipe for a recession. And the reason why the market participants, I say, are not quite prepared for it is because the multiple today, it's 16 times, give or take, and that's not recessionary. We likely need to see that go down to 13 or 14 times in order to say, yes, we truly priced in an economic slowdown that is a recession. Oh, and by the way, we also have to look at the earnings side of the equation, and earnings estimates need to come down by 13% in a kind of typical recession. Again, we are maybe halfway to cutting those earnings estimates, but we're not quite there yet. So that's why for us to truly grapple with this as market participants, as equity investors, we likely need to see the S&P go down to 3,200, unfortunately, to truly price in this current set of circumstances.
On the flip side, people have been trying to go into longer dated bonds, into longer dated treasuries as the hedge, because ultimately they will come down, and it has been a pain trade as those yields continue to climb higher. Where do you stand on this at a time when, yes, we're getting the highest yield going back to the financial crisis? However, there is an inflation experience that we have not seen for decades.
Yes, I think it's a very complicated trade and probably too risky of a trade to have any sort of high conviction on right now. I think you look at the short end of the curve, you can absolutely allocate there. You don't have that much duration exposure. But if you look at the long end of the curve, there's two challenges at least. First of all, if you look at the liquidity in the Treasury market, it is at the worst level since March of 2020. So if anybody's trying to move any size, that's going to have an outsized impact on the Treasury market, and yields can spike higher. And yes, I would love to make the argument that if we are headed for a recession, then yields should move lower in the long end of the curve. But you also have to consider the demand-supply equation of Treasuries. And as I mentioned, we now don't have the Fed that's a buyer. We don't have the banks that are in the market all that much to the extent that they were before. And we also have foreign exchange reserves that are being run down across the world. So you don't have that demand from foreign investors. Oh, and also in currency adjusted terms, U.S. Treasuries are not as attractive as they once were. So I worry that some of these structural issues about liquidity and demand might counteract any sort of yields moving lower because of us pricing in a recession. So that's why I say it's a risky trade and it's a complicated trade, and there's probably better ways to hedge a recession at this point than that.
Anastasia, thank you. As always, Anastasia Amoroso there of iCapital. We're trying to reintroduce price discovery without the participation distortion contributed by central banks, and we're finding it very, very difficult to get to that new destination. Mohammed often talked about that yesterday, has done in the past as well. Finding that new equilibrium is going to be a difficult journey.
Especially when it's not just central banks. It's also international investors, because on a currency hedged basis, as Anastasia was saying, it doesn't make sense. Japan is a huge sort of elephant in the room here. Massive. With respect to purchasing treasuries and not being able to right now.
Still trying to work out what life at the Bank of Japan looks like post-Kuroda, whether yield curve control stays or whether it goes with him.
I think they wonder the same thing. I think that they're curious if this is going to play out.
They're trying to work it out.
I think so. I think that they'd love your input.
In real time. Should I be a consultant?
I think so.
No one needs that, do they?
Messy. It's going to be messy.
That would be a mess.
Yeah.
This is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg. Politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
New intraday low on the S&P 500 for 2022 in yesterday's session, 35.68. Here's the price action this morning on equity futures, trying to bounce back from 5 days of losses on the S&P, up by 0.75%, on the Nasdaq 100, up by almost 1 full percentage point. Unbelievable to think that on the S&P 500, Lisa, we've taken out almost all of the post-vaccine gains of November 2020, almost all of them.
When you put in money and then you take it out, where are we now? And really, how low can it go? And that was what Anastasia was talking about. How much have we already priced in with respect to some sort of downturn to remedy the inflation?
Big turnaround in the bond market, too, that's contributed to a lot of this. The 2-year was about 20-something basis points a year ago. It's now 430, and yesterday came very close to closing at about 435 at the highs of the year. On a 10-year at the moment, 395.34. Yields basically unchanged on the session. Your 10-year still near decade highs of around about 4%. Elsewhere, though, the gilt market getting all the attention for all the wrong reasons. Your 30-year was higher by something like 20 basis points at one point, now up by 15, 495. The drama's not over, might not even be over on Friday when the gilt market operation ends. Maybe that gets extended, but right now this governor of this Bank of England, Lisa, is pushing back, and so is the Prime Minister as well. The governor of the Bank of England is saying you've got 3 days, so you've got a couple of days from Thursday into Friday, and the Prime Minister is saying in Prime Minister's questions in Westminster, in the House of Parliament, that she's not planning UK public spending reductions. They're not backing away either, going into this fiscal announcement at the end of this month.
I keep going back to, at what point do central bankers have no other choice than not to impose discipline necessarily on policymakers, but by pulling back and saying, this is not our gig, this is on you, and we cannot support it because we have a mandate to fight inflation, and that's going to be our priority. Will they have the political will to do that?
Steve Major of HSBC, did you read the piece in the FT this morning?
I did not.
Just a list of recommendations on what he thinks the Bank of England should do. Also has a suggestion for the DMO, the Debt Management Office in the UK. So something we've talked about in this programme a million times is that the average maturity in the UK is something like 13 to 14 years in the gilt market. He thinks you should bring that in. If you're going to issue debt off the back of this fiscal plan, do it at the front end. Don't lock in what's happening at the long end. Maybe shorten the maturity up a little bit. Then the Bank of England can come out and have some kind of permanent operation at the long end. And if you're going to do active QT, you can do that too, but maybe don't touch the long end, do something towards the front end, and then raise rates at the same time and reconsider how far you're actually going to take those interest rate increases.
Incredibly smart, and I can understand this taking shape, at least from a market perspective. I cannot understand this taking shape from a political perspective, because it goes very directly to them really offsetting a plan by a prime minister.
There's just no optimal policy response.
No.
I think we're all just sort of scrambling, trying to think about what is the least worst option right now. And that doesn't just apply to the UK. I think that applies to a lot of places.
And that has to do with what's going to happen with CPI in terms of inflation later this week on Thursday, tomorrow. And then on Friday, we start to get some of the earnings, particularly with the big banks. And right now, what you're seeing from specific companies, just a real divergence in terms of which companies can pass along the prices. They see the higher prices and which can't. And I point to Intel. Overnight, they came out and they said they're going to be cutting thousands of jobs, potentially their first massive job cut program going back to 2016. There's been a well-publicized feeling of just how much pain a lot of these semiconductor companies have been feeling. Intel shares have been down nearly 50% year to date, more than 50% year to date. They are up slightly in pre-market trading. Are chip makers really the tea leaf for the rest of the economy? And I keep wondering this when you talk about Apple, when you talk about Google, you talk about the demand for some of these products. And John, I think that that's increasingly going to be a conversation.
There's a geopolitical overlay in all of this as well. Yes. But I think we've started to see this across a range of industries, from Nike with too much inventory to FedEx, which is seeing a really sharp slow off into earnings season. I think that's the number one reason, a primary reason why a lot of people have pulled back on expectations for this earnings season. We had Ben Laidler with a bullish view from eToro about an hour ago, talking about maybe you skip over a low bar in 3Q. Maybe you do. But Bank of America are making the point. Guidance for next year, for the next quarter, for the next 12 months. How optimistic can you be when global growth is set to decelerate even more? Well,
and I will just point to this, because on the flip side, just to sort of give a note of optimism from people who say that I'm about to, fall off a cliff here, you did see Pepsi actually upgrade their forecast for their earnings, and you saw this despite the fact that they raised prices for consumers. They're able to pass along prices on chips, on soda. Is this a sign of weakness because people are downgrading what they are buying in terms of food, or is this a sign of strength? And how do you sort of suss these aspects out with some sort of longer-term projection?
So this is the number one for margins. When you look at inflation coming down, if it does come down over the next 12 months, what really matters to margins is what pocket of the inflation story is sticky and what fades. Do these companies lose pricing power at the same time that the wage cost story remains sticky for the rest of this year? That just screams smaller margins. It was interesting to hear from Vice Chair Brainerd in that speech. She talked about the potential for margin recompression.
Yeah.
That's the Vice Chair of the Federal Reserve basically telling you there's huge scope for profits to come down in corporate America.
And this is sort of the opposite of what we saw for so many years, where markets did better than the economy, and they're trying to shift that and have the economy do better than markets at a time when you're already seeing stickier wage growth. This is what Larry Summers was saying just yesterday.
Joining us now is Rabila Faruqi, the chief US economist at High Frequency Economics. Rabila, we look at the labor market data and it tells us that things are okay. Do you think that overstates what's actually happening in this economy?
Great to be with you. Thanks for having me. I do think that the labor market data is telling us that the U.S. economy is certainly not in recession and certainly not in contractionary dynamics. But, this is not a leading indicator. Things can change very quickly. We've seen that, that's been the typical pattern. So we are taking some comfort in the fact that the labor market is hanging in. But, with the Fed, with policy really, aiming at softening the labor market, I think that's going to be the next thing that we see over coming months, a slowdown. What we're really trying to figure out right now is things are still positive, manufacturing is still growing, services are still growing. At what point do you go from, the positive impulse to a negative impulse? And that has been very difficult for us to assess.
Rubile, just to stay on wages for a moment, Larry Summers in a conversation with Citigroup yesterday said that he'd be watching wage inflation very carefully, that he thinks it's a lot stickier than people currently appreciate. And he said, you cannot become a low inflation country with a high wage inflation, and wage inflation is looking pretty high in the United States. Do you think that there is an underappreciated risk of a wage spiral?
We don't see a wage spiral right now. We do think that the risks are certainly stacked, somewhat in that direction, just because we're not seeing the supply come back. But I do think that, policy right now is directed at bringing that demand down to match supply. Whether the Fed is going to be able to do that successfully or not, it remains to be seen. But we've seen very aggressive moves so far. And that it will weigh on demand pretty substantially, demand for labor. So I do think that, we don't really see that dynamic playing out right now, but the risk is certainly there.
The other thing that he said, that he thought that NAIRU, or the neutral jobless rate required to get inflation under control, post-pandemic will be a lot higher, that it will be about 5% rather than the 4% that people had previously been looking at. Do you agree with that?
I certainly think, and Fed officials have also weighed in on this, I certainly think that there is, narrow is probably higher, at least over this period of time, just because of where, what the dynamics are in the labor market. But I do think that in the longer term trajectory, I don't think that we're much different from the 4.5% that, Fed officials have marked. But yes, it certainly does create a challenge in the very short term, because with an unemployment rate that's at a 50-year low of 3.5%, if narrow is higher, then definitely there needs to be an adjustment.
Rabila, as you look at what's playing out in the UK right now, is there a lesson in there somewhere for this Fed?
Absolutely. I mean, the lesson is that the risks are definitely elevated of a financial event. But, if you hear from Fed officials, they're saying that, markets are functioning. They have an eye on what's happening abroad. They have an eye on what's happening in global markets. But yeah, I mean, we do think that there's a risk of a financial event that's going to feed into policy decisions. But, for now, the U.S. markets, the global markets, these are isolated events. There is a risk of a spillover. But, we are keeping an eye on it. But we don't think that, risk of contagion, of global financial market meltdown, is really unfolding right now.
Rabila, thank you. Rabila Faruqi there of High Frequency Economics. Just to set the scene for you, happening at the same time right now, the Prime Minister addressing the House of Parliament, speaking in London in Prime Minister's Questions. At the same time, we're hearing from the Chief Economist of the Bank of England, Hugh Pill. The Bank of England's Hugh Pill saying a significant monetary policy response is required. Lisa, November 3rd is their meeting. A significant monetary policy response is required. Slower demand growth will cool wage growth in the UK. He characterises tight labour markets pushing up wage growth as a mixed blessing for the United Kingdom. I wonder how the government would see it, and isn't that the problem? Yeah. I think that line almost captures everything that's wrong right now with the way the government would like things to be and the way the Bank of England would like to see things evolve.
The government, pretty much globally, governments want to see low unemployment rates, want to see people fully employed, want to see an economy that's strong, but want to get inflation down. And that is an incoherent reality, at least according to a lot of policymakers. What I found interesting when I saw that headline that Hugh Pill said significant monetary policy response is required, my first question was, to what? Are we going to talk about inflation? Are we talking about the disruption in financial stability on 30-year gilts? And that's also part of the problem, because they're dealing with both potential policy responses at the same time. Again, these sort of incoherent battles that they've got to be fighting.
Credibility is a word. Market volatility underlines the need for credibility.
Yeah.
Credibility on what? On getting inflation back towards target? Being credible enough to make sure that they can maintain financial stability? Credibility on what?
It's a great question. Or credibility that they're going to have the same message next week. I mean, that's the other issue, is that they're changing in real time according to the data. So what are they targeting? And if they start to target financial stability too much at the expense of inflation, then to your point, is it an issue of backing the market and backing market activity above anything having to do with inflation? And then what does that do in terms of leaving yields higher for longer?
I just get the impression from them they don't want to give the impression that they're doing anything other than focusing on getting inflation back towards target, that is the mandate of the MPC. And the financial stability concerns are something they can address separately, but ultimately there is this line in the sand just to establish that there are no blurring of the lines here, even though we can all see how the lines blur.
At one point, are they going to have to come out and say, look, these are incongruous and we are going to have to just fight inflation?
Well, this gilt market operation might end on Friday, but maybe you get another one for Monday.
Let's see what happens. Messy.
Then you never backtrack, did you? It's just different.
Different. I like that.
Futures up 0.75% on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The UK economy shrank unexpectedly in August for the second time in 3 months, raising the possibility that the country is now in a recession. The Office for National Statistics says the sharp 0.3% drop in industrial production was the main cause for that decline. Global household wealth is on track for its first significant contraction since the great financial crisis of 2008. That's according to a report by Allianz. Now, a global wealth report published today finds 2022 is likely to result in a nominal drop of more than 2%. Allianz researchers called this year a, quote, turning point for global wealth amid scant signs that a meaningful reversal will follow. An older and cheaper class of diabetes drugs appeared to lower the risk of developing dementia. That's in a new study. People who took an older class of diabetes drugs known as giltizones or TZDs had a 22% lower risk of developing dementia in an observational study that was published in the journal BMJ, Open Diabetes Research and Care. The most common type of dementia, Alzheimer's disease, is a massive target for pharma companies looking to develop therapies. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation? Fed just has a long way to go.
Instant reaction on Bloomberg Surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us. I think we're quite a ways away from a pause.
This is a Fed that will blink.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in Focus, tomorrow on Bloomberg.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
Material samples brought back from objects in space can shed light on billions of years of our solar system's history, including details about the origin of life here on Earth.
A piece of an asteroid is a piece of the earliest beginnings of the solar system.
But picking up rocks from the surface of an asteroid or planetary satellite isn't as easy as it sounds. It requires voyages of millions of miles to bodies that have never been seen up close. Probes need to land on surfaces with weak gravitational pulls, where the surface terrain is completely unknown, gather samples, and then make the long trip back. And while behemoths like NASA and SpaceX grab headlines, it's a relatively young space agency. The Japan Aerospace Exploration Agency, better known as JAXA, that is taking the giant leap necessary to bring the mysteries of space back down to Earth.
I think there's a sense of catch-up that they waited too long. Granted. And so they want to make up. I think some of it is just bringing back the reputation of the institutions. There's a concern that maybe the Fed or other institutions have lost some of the reputation as being tough. I think Jay wants to prove a point. And I think you heard from Andrew yesterday. He wants to prove a point, too.
They all want to prove a point. Great conversation with Tim Adams there, the president and CEO of the Institute of International Finance. You know what my favorite guest is? Someone who used to be a central banker but isn't anymore, because they can now tell you what they think.
And all of them come out really harshly and say, they're all making a terrible mistake. Why aren't they going more aggressively?
They're just so much more open about their feelings about the situation. Tom Keene, I think you've got the perfect guest to do just that.
My interview of this meetings of the International Monetary Fund, and it's here at the Institute of International Finance. Axel Weber is the force of the IIF, the chairman, but I must say, far more importantly, the former president of the Bundesbank. His service to UBS is noted as well. We begin a one-hour conversation. We're going to have to cram 1 hour, Axel, into the moment at hand. You taught a course at Booth School, Chicago, Central Bank Theories and Fact. What is the fact right now for Jay Powell?
Well, I think the fact is that central banks are in a really bad situation. They have started late in raising rates. You could see already some trend break in the price level in late 2000. They focused on the inflation rate very early, also some elements that have been going up strongly. And now the central banks are doing big steps to catch up with reality. And there is some risk in that. So I now look at monetary policy as an independent risk factor. And I think monetary policy has a way to go. I don't believe that the current inflation rates will come down as easily as is predicted still by most of the central bank models.
Right.
So the tough work is ahead.
I got so many ways to go here. I'm just to squeeze this into time. Do we need to abandon the 2% level, something Bundesbank is comfortable with, something I'm going to say traditional economics is comfortable with, but as part of the solution to move away from a 2% level of inflation towards a 3% level as appropriate?
I think that would completely blow the credibility of all central banks if they were to do that. They would be dead on arrival, because what you need to do is to reestablish the credibility of the 2% target at a rate running just below 10%. That's a very difficult task. So central banks would, in my view, be completely misguided if they were to question the target now. The point is, let's get back to target, and that will take them, at least 2 years.
What we're going to do now, folks, is dive into some theory, and we can do this with Professor Weber. I'm going to work off of a wonderful piece by Ambrose Evans Pritchard in The Telegraph. You can look at a theoretical construct like the Phillips curve, London School of Economics, the 50s, or the Beveridge curve, which Krugman talks about from even farther back as well. Central banking is hinging on a linkage between inflation and employment. Should they do that, or do they need to squeeze right down to a more Germanic focus on inflation?
Well, I think they're long term. What really matters is the amount of debt in the economy and how it's accommodated by central banks. So I'm still a firm believer that in the long run, the balance sheet of the Fed and monetary policy matter. And in the long run, inflation is largely driven by factors like how accommodative are central banks for government debt. Of course, in conducting monetary policies through the business cycle, they need to look at the link between output, growth, employment, and inflation. It's a natural because their setting is within the economic, in the economy. But long run, I think they haven't looked at the impact of this ultra easy monetary policy on inflation that was about to come.
How naive are we about QT? Original, unfounded. Rubini, among others, made jokes about it. QE, QT. How original is it in that we don't know really what's going to happen with it?
No, I think the central banks have amassed a massive balance sheet, all central banks in the world. And if you look at the last 10 years, the fiscal expansion of roughly to the tune of 25% of GDP globally has been accommodated by an expansion of central banks' balance sheet roughly of the same amount. So this additional government debt didn't have to be held in the market. It ended up in another government balance sheet by the central bank, and we haven't seen the interest impact and the long-term inflation impact of that liquidity having to come from the market as opposed to come from another source of government funding. And I think long run, central banks need to bring their balance sheet down.
Right.
That will put pressure on debt and governments to consolidate. And I think long run, we cannot continue to run deficits that are, mid-single digits and debt that is around 100%.
Your history is you are death on short-term, medium-term, long-term analysis. It is a responsibility, a character out of Bundesbank that speaks for itself. Is the short-term path here to just extend things out, to ease up on the raising of interest rates at an appropriate point and use time to heal the wounds of the pandemic and this debt expansion?
Well, I think you need to start doing the U-turn. This is a change in times.
Are we near the U-turn?
I think central banks have started to raise rates late, but in my view, they started. And now what is important is what Jay Powell said at the Jackson Hole speech. You got to keep at it till the job's done, and the job is not done. And so central banks have to raise interest rates, and at the same time, they have to reduce their balance sheet.
How constrained is ECB? How many degrees of freedom has Madame Lagarde lost here with a war plus the overlay we've been talking about?
Quite a few. The ECB is in a worse position than the Fed. Their economy is likely to take a much bigger hit. Their monetary policy has weakened the euro, and that has increased price pressures for European citizens. We're much closer to the war, and we're much more dependent on China in our exports, and China is not doing well at the moment.
Is it true when you were at Booth School teaching that you gave out no A's and no B's? Were you that tough a grader?
No, I wasn't. I did have some A's and B's, but they were clustered around people that understood the long-term implications. Let me remind you, that was in 2011. There wasn't a textbook from which you could teach the financial crisis because those textbooks were still to be written.
10 seconds. Is there a textbook now for what we're in?
There are good textbooks now, yes.
There are good textbooks now. Excellent over there with some assurance here. Of course, the chairman of the Institute of International Finance, a former leader of the Bundesbank. John, you and I would have gotten quality D's in that course.
I'm not sure I would have done that well, Tom. Hey, Tom, I can hear them getting breakfast ready. You've got a 10, 15-minute break, I think, before our next guest. You get going. TK there, down in Washington, D.C. Go on, Tom. I think he's gone. They closed the mic. It's a wise thing with TK. Coming up in about 15 or 20 minutes, he'll catch up with the governor of the Netherlands Central Bank. Looking forward to that conversation. Al-Arian Mohammed out on Twitter just now. A major government policy reset is becoming even more urgent. That's his line on the UK. Here's the line from a minister of the Treasury in the UK moments ago. No plans to reverse tax measures announced in September.
And this is where the rubber meets the road for the Bank of England. And to Alex Weber's point there, do they say we are not going to facilitate this spending? We are not going to come up with a circuit breaker. This is on you, and we're going to fight inflation. That is our mandate. If they get that, yes, you get financial markets dysfunction, but that is exactly what Alex Weber was saying in order to bring down debt, in order to inflict some discipline after a decade of central banks giving them a pass.
You saw what Tim Adams said. They want to be tough. I think Jay wants to prove a point. I think you heard from Andrew yesterday, wants to prove a point.
To who?
It's on a first-name basis with them. Do you like that, Jay and Andrew?
I mean, he's been interviewing them all, so there you go. But to who is my question.
Precisely. From New York City this morning, good morning. This is Bloomberg.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that It keeps evolving. You know, we started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
In the U.S. markets, they're still functioning, but liquidity is kind of dear.
People are looking for liquidity and going where they can find it.
It's just this uncertainty just keeps weighing on investors.
The economy is starting to go through the windshield. The financial system is starting to go through the windshield.
For some economies, they're not only through the windscreen, but they're under the wheels.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Trying to bounce back from a 22 low in the equity market. Live from New York City this morning. Good morning, good morning. For our audience worldwide on TV and radio, this is Bloomberg Surveillance. Lisa Abramowitz in yesterday's session. New lows in the equity market, new highs in this bond market.
Readjusting for a moment in which financial instability is going to trickle out and central banks are somewhat tied in terms of how they respond to it. And that, to me, was really a takeaway from a day when we saw the United Kingdom grapple with this question of how long their program was going to be and whether the market pushback would cause them to cave.
We've talked a ton about policy being in conflict, particularly between fiscal policy authorities and monetary policy officials at the same time. Within the central bank over the last couple of weeks, we've got a new conflict, the conflict between preserving financial stability and addressing inflation. And the Bank of England right now is trying to address that, and they're finding it very, very difficult to do.
At the heart of that conflict is a question about what the policy response is in the fiscal world, how much they can really coordinate or diverge from what you're seeing from politicians that want to see everything go right. They want to see the economy do well. They want to see people remain employed. They want to see wages rise in tandem with inflation, but then stop. They want something that cannot be achieved without some pain. And how much discipline do central bankers have to keep going at a time when they have the extra financial stability concern at the same time?
There's a trade-off somewhere. It is the policy trilemma of 2022. Right now, yields are up higher in the UK on a 30-year by around about 15 or 16 basis points, back to 493. breached 5% very briefly a little bit earlier this morning. Elsewhere, futures are positive, up 24 on the S&P, up 0.7%. Yields just a little bit higher by a basis point at 395.96. And we've still got this week, Lisa, CPI tomorrow and bank earnings Friday.
It's going to be a wild week. And just today, we do get PPI, the Producer Price Index, coming out for the month of September. In about 30 minutes' time, there is a question of how much deceleration there will be, particularly as oil prices continue to come down, with OPEC just coming out now and saying they're expecting oil demand to come down, basically trying to justify why they are cutting production. 1 p.m., U.S. is planning to sell $32 billion of 10-year notes. Who is going to buy them? This is one of the key questions as you see central banks pulling back and Japanese investors, UK investors. Where is the marginal buyer? Can we do price discovery after a decade where it did not exist? And at 2 p.m., we get Fed meeting minutes coming out. Can we parse through some of the guidance, or is it the same message? Inflation is number one. You cannot have a steady labor market. You cannot have a steady economy without some sort of price stability. Is that going to be the full message? Will there be some sort of signs for people to hold on to and plea that perhaps this could mean some sort of deceleration in rate hikes? And then we get the Fed speak to help confuse the issue. Neil Kashkari, Michael Barr, and Michelle Bowman. You know, who matters when we hear all of these Fed officials speak? And will they come out with a willingness to push back against fiscal policymakers? I think this will be increasingly a question, John, at a time when you heard Axel Weber there talking about the need to cut debt in order to really make this a more sustainable, less central bank-backed market.
Tim Adams of the IIF with Tom Keene this morning. They want to be tough. I think Jay wants to prove a point. I think Andrew wants to prove a point. He's talking about Bailey and, of course, Powell as well.
Just prove a point to markets, or also prove a point to policymakers in terms of what is and what is not financially feasible when it comes to financing?
Tom Keene down in Washington, D.C. for us. TK, great interviews through this morning, buddy. Let's just talk about that line from Tim Adams to you about an hour ago. They want to be tough. They've got a point to prove.
The toughness for Tim Adams, meeting with Mr. Kuroda now here at the IIF, or for the giant Axel Weber, John, is simple. They're focused on tomorrow's CPI number. I think we haven't made enough of the importance of that data point tomorrow to the international community. We're going to drive forward that conversation with someone who knows 11% inflation. And John, you know that's the Netherlands. We'll speak with Klaus Knot of the Dutch Central Bank.
Very excited for that, Tom, as they look to push forward potentially with a 75 basis point interest rate hike. Tom Keene coming up with the Dutch Central Bank governor in around about 10 minutes' time. Joining us now is Lee Ferridge, the head of macro strategy for North America at State Street Global Markets. Lee, I think you and I are coming up against the same conversations. A group of individuals that performed tremendously well over the last 10 years, post-GFC, conditioned by their success, rewarded for it, who just wait for that moment to say, when can I buy again? Rates are going to turn, tech's going to rip, I want to get back in. Lost decades, Lee, aren't unique. Do you think we face the potential for one now in certain pockets of this market?
Yes, I think we have to accept that potential. I mean, you're right, that there is, even it seems so strange to say when stocks have hit their lows, we're down 20-odd% this year, 30% in some areas. There is in the market still this default to optimism. So any bit of news, oh, the Fed's going to pivot, that means we can start buying. And it does come from the conditioning of the last, 2008 through to 2020, where buy on dips worked. The central banks always had your back, because whenever markets sold off, we saw a loosening of policy, restart QE, and therefore it was a great buying opportunity. Any big drop was a great buying opportunity. This is different. In that period there, central banks are more concerned with below target inflation than above target inflation. That's not where we are now. That game is up. So this idea of default to optimism is really misguided, but we keep seeing it. We keep looking for this Fed pivot. Let's fight the inflation first and then worry about that. But yeah, you're right. Look, that 12 years was all about QE. The G3 central bank balance sheets went from $4 trillion up to $27 trillion. That's what underpinned that market. That doesn't mean we're going to see that over the next 10 years.
John put it into perspective just moments ago, Lee, when he was talking about how the S&P has given up almost all the post-COVID gains. How far are we retracing? Do we go back to levels seen before some of the monetary stimulus, but before the regime that you're talking about? Or is this sort of finding a floor to then create something new that we're closer to than perhaps further away?
It's a really good question. Look, I don't think we're going to go back to 666 on the S&P, which we hit in March 2009. Even I'm not that bearish. But look, could we see another 10, 15% from here? Yeah, quite honestly, because when you look at long-term valuations, we're still above the long-term average. And this is the most challenging fundamental backdrop we've had in 40 years. Well, guess what? 40 years ago, equity valuations were way below that long-term average. So, it's very easy to see these losses continue. And I think we still haven't really factored in the new regime we're in. There is still this hope. You look at interest rates, you look at inflation swaps, there's still this hope. Inflation comes down quickly. The bank, the Fed starts cutting towards the end of next year, and that's going to underpin the next rally. And it's sort of, look, we're not going to get that monetary stimulus we've been used to. I think we have to look ahead at least a few years and excellent interview with Axel Weber then. This is a different era. Now it's about shrinking balance sheets. It's about reducing debt rather than the buildup we've seen over the last 12, 14 years.
At least some of what you said echoed what Jamie Dimon said to Juliana over at CNBC earlier this week, the potential for another leg lower in the equity market. He also talked about the pain that you get from the next 100 basis points of tightening that you didn't get in the previous 100 basis points. Why is the next 100 basis points that much more painful?
Well, you're going into restrictive territory. I mean, we can argue where neutral is, and personally, I think neutral is a real rate rather than a nominal rate. So I'm not even sure with inflation where we are. We can say we're at neutral, but the theory is that neutral is around 2.5%, 3%. We're now just around that. So now we're going into restrictive territory. I'm not so sure the next 100 matters more than the previous 100. They all add up together, and it's a cumulative process. But, certainly, for me, the Fed's not done. I mean, look at the data. Look at payrolls. We've got CPI tomorrow. Even if we get a consensus core, it's 0.4. That's 5% year on year if you annualize that up, right? So, that's nowhere near where the Fed wanted to be. So, against that backdrop, how can we talk about a Fed pivot when we're adding 260, 270,000 payrolls, the unemployment rate drops, and we're running core inflation annualized this month, potentially at 5%?
Lee, you won't find a strategist. You won't find a strategist that wants their clients in cash. So, Lee, can you tell me, is that the message you are conveying? Just be patient, just wait for the storm to pass.
Absolutely, 100%. You see, what you forget, I'm an FX strategist primarily, so I'm quite happy with cash. So listen, that's the place to be, without a doubt. Stop trying to pick this bottom. Stop trying to look for that pivot. You got to ride this out, I think, for at least the next 6 months, maybe towards the end of Q1, start of Q2. If we start to see payrolls falling, if we see consistent 0.2s or below on the core CPI, then we can start having the conversation. We are not there yet.
There's always a vested interest somewhere. Hey, Lee, thank you. Good to catch up, sir. Lee Ferridge there of State Street Global Markets. I'm an FX strategist, stay in cash. Yeah, I don't mind that.
Exactly. I like that you basically were saying, do you think that there perhaps is a conflict with an institutional equity investor saying, just stay in cash, be patient?
You've got to understand, I think, even as a portfolio manager, that there's some people paying fees to you, and it's hard to make the argument that you should just be in cash, which pushes them to be tempted to do something that they otherwise, I guess, wouldn't want to do.
How many people come on the show and talk about how they need to stay invested? They're paid to stay invested, so they need to make some bets and make relative wagers. And he's basically saying, well, I trade FX, and I'm still trading, but yeah, stay in cash.
I've been trying to listen much more to the bearish voices out there that are thinking about this moment a little bit more analytically than perhaps the perma bulls of the last 10 years or so. Hugh Hendry in his podcast I thought was absolutely brilliant. He had a retail investor on, and the retail investor said a line that we hear all the time, which is, over the long term, I'm long stocks because long stocks reward you over the long term. And Hugh turned around and he said something that I hadn't heard before, because usually we just let that line go. And he said, okay, you're basing that on 120 years of US market history, which just happened to be the time where the US rose to be the hegemonic power and all these great tech companies came around as well. Is that a big enough sample of data to make the assessment that the next 10 years is going to be great just because the last 100 were?
It points to a lack of visibility at a time of sea change when it comes to monetary and fiscal policy, and perhaps the globalization or re-globalization of a world very much in flux.
I just see a lot of bulls struggling to adjust to a new regime, sort of scratching their head and having some empty conversations with them. I look depressed, don't I? I know.
Yeah, you're like, I'm listening more to the Bears. And I feel really sad. But, there is a fair question.
Just trying to gauge what's happening.
How do you get new parameters for a world where central banks are much more constrained?
The Dutch central bank governor coming right up with Tom Keene from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden is voicing his fury with Saudi Arabia over OPEC Plus oil production costs, accusing the kingdom of allying itself with Russia and vowing to engage with U.S. lawmakers clamoring to punish Riyadh. Now, the president added that he believes it's time for the U.S. to rethink its relationship with Saudi Arabia, but administration officials say a legislative plan to retaliate is unlikely to materialize until November's midterm elections. Global household wealth is on track for its first significant contraction since the great financial crisis of 2008. And that's according to a report by Allianz. A global wealth report published today finds 2022 is likely to result in a nominal drop of more than 2%. Allianz researchers called this year a, quote, turning point for global wealth amid scant signs that a meaningful reversal will follow. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Connection lost.
When the price of anything goes up, the consequences reach far beyond what you'd expect. But perhaps most of all, when it comes to food.
Connection lost.
In 2010, surging food prices helped spark the Arab Spring. Lives were lost, regimes fell, and the consequences are still with us. Once again, food prices are rising, and fast. Energy costs, broken supply chains, and surging demand were just some of the factors that have driven food prices to their first record high since the Arab Spring. And that's all before a war between two of the world's biggest food producers. Ukraine is called the breadbasket of Europe, and taken with Russia, the two account for about a quarter of global wheat trade. They produce more than half of the world's sunflower seeds and oil, nearly 20% of the barley. Now throw in rising energy prices, and processing, transporting, even refrigerating food gets more expensive. Plus, fertilizer production is extremely energy intensive. Less fertilizer means lower crop yield, and prices rise even more. The pandemic revealed how complicated and fragile global trade systems are. Global agriculture, perhaps even more so. Unlike metals, for example, food goes bad. And crops take months to grow and are vulnerable to unpredictabilities like the weather. Rising food prices will be felt everywhere, but the poorest countries in the world will be hit the hardest. And as all these factors compound, the real fear is that record high will lead to record high, and ultimately to a global food crisis with vast consequence.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news, you will get insight into limitless possibilities. Before you change the world, Bloomberg.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
When we were hit by the pandemic, Europe reacted in a very decisive manner on the basis of unity and solidarity. I think that now, this time around, that we're faced with global challenges again, a war at the doorstep of Europe, we should react with the same principles. You know, whether that entails additional debt issuance or not, we will see.
Nadia Calvino there, the Deputy Prime Minister of Spain, answering Mohamed Al-Arian yesterday and not me. Have you noticed that? I love having Mohamed on the programme with me. We've done it a few times over the years, but he always asks better questions than I do. And I try and rein back the interview, but not successfully.
You both did great.
Thanks, Elisa.
Anytime.
I appreciate the
I really
support,
enjoyed
Bravo.
it.
I really
try.
do.
I try.
I think TK said this about Tim Adams a little bit early this morning, that Tim Adams is much better at doing this than maybe some journalists out
He said that we would lose our jobs if he keeps breaking news at the same kind of pace.
Hey, Tom, do you think Tim Adams wants to be an anchor on Bloomberg surveillance when you're out?
Well, he's smooth. There's no question about it. The gentleman from Kentucky can absolutely get it done. And for that matter, John, I thought Axel Weber was smooth as well.
Agreed.
Your thoughts, John Farrell, on what we heard from the leader of the Bundesbank?
Well, Tom, I think a lot of what we're experiencing right now is some of the stuff he warned about more than 10 years ago, that once you go down this path, it's very difficult to get back out of it.
From the ultra-accommodative to where we are right now, it is indeed historic. What I've heard this morning, folks, is this is a once in 40, even 50-year moment for all within finance and global Wall Street. If you're part of global Wall Street, this is must listen. It is rare that you speak to anyone in economics who actually read chapter 23 of a textbook which is on finance and bonds. Klaus Knot is a governor of the Dutch Central Bank and is truly expert at linking in economics to the fixed income space, including British yields at 5%. Governor, thank you so much for joining Bloomberg today. I've got to first go to the ECB questions. Can you explain to me how the ECB can become more restrictive, raise rates 75 basis points with a nominal GDP construction of the continent? Where do they have the animal spirit to withstand ever higher interest rates?
Well, I think to answer that question, you first have to sort of look at where we are in terms of the starting point. We're still way below neutral, so policy is still accommodative. So I think it is a no regret that we have to end this accommodative phase of policy. And I mean, your question of how deep should we go into restrictive territory once we get there, well, we'll cross that bridge when we get there.
It is original. Right now you're in accommodative or ultra-accommodative, however you want to phrase it as well. What happens next after the presumed rate increase of the next meeting?
Well, I mean, our president has stated very clearly that we are currently in the phase of normalizing interest rates. That means taking them to neutral. Unfortunately, nobody knows with any level of precision where neutral is. But I've been saying that we need at least 2 more significant hikes before we sort of enter the range of plausible estimates for neutral. That'll take us into next year, and I hope that with the current uncertainty in the markets and the bond market fragility, I hope you don't mind that I don't have my calendar cut out for 2023 already.
I don't have my calendar cut out for 2022. Even some of my staff would say that I don't know where the calendar is for this year as well. I stood at the ECB building with Otmar Issing long ago and far away, and it was a core, let's call it Germanic Netherlands constituency wrapped around another ECB. In this crisis right now, is the ECB more unified than it was in 2008?
We are unified. So I think if you look back over the last few years since the pandemic, all decisions have been taken with a high degree of unanimity. So we are very clear about our mandate. Inflation is way too high.
Yes,
It is persistent.
11% in the Netherlands.
11%, 17% in the Netherlands, 10% in the euro area, and even more important, underlying inflation trends are pointing in the wrong direction. Core inflation, almost 5%. So we are determined to bring inflation back to the target, and we do understand that this will require some further efforts from our side. This problem is not going to go away with a little bit of slowdown of the economy. It will require continued effort from our side, and the Council is unanimous on that.
And Ty, I have to go with you to your bond expertise, linking it into a greater economic system. And the idea of yields coming up, prices coming down, with the United Kingdom being in the headlines this morning. It'll be another country next. These are nonlinear functions. How close are we to a second derivative, to a convexity and acceleration where people like you lose control?
Well, I think that need not be the case, because that is dependent, I think, on responsible policy. As long as policymakers keep on doing the responsible things, then I do think bond markets can be in control. But it does put a premium on responsible behavior. Bond markets have become much, much more sensitive to debt sustainability issues. So that puts a burden on our fiscal authorities to also continue to pursue responsible fiscal policies with a medium-term orientation, and with debt sustainability being front and center of their concerns.
Is there a textbook on QT? When you're at Groningen, was there anything about QE and QT?
No,
you're making it up as we go, right?
Well, we're making it up as we go. Yes, of course, we learn from the experiences of other central banks. I think the way the Fed is dealing with QT, that's clearly also going to be an example for us. They managed to move it into the background very quickly. I think a process like QT, it should be predictable, it should be gradual, it should be even a little bit boring, right? I mean, Janet Yellen once quipped, it's like watching paint dry. And that's a little bit, I think, how you want to shape such a program. I think the Fed has been fairly successful in that. And if we can take that cue as well, I would be more than happy to do so.
It has not been boring for Governor Bailey. He's making it up as he goes, literally in the last 24 hours. What are the lessons you've learned from the nexus of Bank of England and politics in England? What have you learned about when that breaks?
Well, first of all, that monetary and fiscal policy being at crossroads, at cross purposes with each other, that's a very dangerous cocktail for bond markets. That's the first lesson that I would say. And secondly, the UK is a little bit in a special position because the bonds they bought are extremely long dated, so they actively have to sell. We in the euro area, like in the US, we have bonds over the full maturity, and we think we can do QT by just rolling off existing bonds by less than full reinvestment, which is naturally a smoother process than having to actively sell.
My colleague John Farrow adores Vermeer. You're having the mother of all lifetime Vermeer shows in the Netherlands next year. Can you see our show in Amsterdam in support of the Vermeer show?
Yes, of course. I mean, if you want to support it, by all means, I think it's a unique opportunity to see all the Vermeers that are everywhere in the world in a different museum. In the Rijksmuseum in Amsterdam, absolutely.
We would love to have you and Mr. Ruda share the
You would
desk
be
with
more
us.
than welcome to come and enjoy our hospitality.
There we go, John. Road trip. Klaus Knot of the Dutch Central Bank suggesting we need to be in Amsterdam next year.
Yeah, it was his suggestion, Tom. I'm buying that. Why is there always a trip involved somewhere? Somewhere.
He's on a road trip, bidding for another road trip, and he's saying it's his suggestion because there was a Vermeer show. Didn't you hear him mention it?
He left out the bit about which bar he'd like to go to in Amsterdam. I'd love some more detail on that, Tom. He's usually been to one.
To be honest, that point that was being made just there from the central banker was the same that we heard from Axel Weber, which is this ultimately comes down to fiscal policymakers being disciplined. That's where it goes.
That was one point. The second point, let's talk about the aspirational goals of these central bankers.
That's the other point.
QT paint drying?
Yeah.
Yeah, come on.
It's really
Give me a break.
Boring.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
The Fed just has a long way to go.
Instant reaction on Bloomberg surveillance.
Inflation is still sticky.
The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blame.
The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in focus tomorrow on Bloomberg.
CPI coming up tomorrow, about 24 hours away. Seconds away is PPI in America, and the equity market was shaping up as follows going into those two prints. On the S&P 500 positive by 0.8%. Yields coming in a couple of basis points on a 10-year to 392.68. I can tell you on PPI, final demand month over month, upside surprise, 0.4%. The survey, median estimate 0.2%. Year over year, 8.5. Median estimate 8.4. I was reading food. I can strip out food and energy for you. Ex-food and energy month over month, positive 0.3, basically in line with estimates there. Ex-food, energy and trade, 0.4. We were looking for 0.2. If you want to do the year over year for food and energy, 7.2, just below the 7.3 we were looking for. Let's get out to Mike McKee now to break down some of this data. And Mike, I guess my first question for you, as this data simmers and we look ahead to CPI, is how relevant is this data when we think about tomorrow's?
It's not particularly relevant because the PPI doesn't feed directly into CPI. The middlemen get in the way, but it does tell us something about inflation pressures in the pipeline, and it's telling us there are still inflation pressures in the pipeline. So it's not going to make anybody on Wall Street happy. CPI is going to be the big number of the week. It's probably not going to change any minds at the Fed unless there's a major surprise. They're pretty locked in on the idea of 75 basis points in November, but it will give us breakdowns of where inflation is still heavy. And that's going to be important for the way the Fed thinks about what it's got to do, because it has to be it has to make sure that monetary policy will actually have an impact. Certainly with gasoline prices, things like that, it doesn't.
On peripheral conversations that I've been having, there is a growing fear that we have not seen peak inflation, that certainly core will continue to gain. I'm talking about CPI. Given these PPI numbers coming in higher than expected, Mike, in your conversations at IIF and IMF, how much is that a pervasive worry?
You know, it's kind of evenly divided. There are people who think that this is going to take a very long time, and I've talked to a number of central bankers. They're all over the place here in Washington, and they all feel that it is going to be a long road till you get inflation back down to target. That doesn't mean that we haven't seen peak inflation. Could come this month, might have already happened, but it is not going to go down very quickly, and that's going to be the important thing. And that's the argument Fed officials make, is we've got to get our target rate up to a restrictive stance and keep it there, because if we get up and start cutting, we're going to see inflation just stay high and not keep going down. So that'll be the tug of war that gets into the markets coming next. Whether we've hit peak this month or next month, it's going to be about how long you keep rates high.
How sticky will this story be? All round. Mike McKee, thank you. Looking forward to Mike's coverage through the week down in Washington alongside Tom Keene. I know we've all got a home bias, and being in New York, it's in the rents. The story, August, year over year. Latest data. We were up in August 19% for rents, 19% higher. The national number was 12%.
Any particular neighborhoods that got your attention?
No, not in
on
here.
a personal
I haven't
level.
got the full neighborhood breakdown for you, but the overall number is pretty big.
It's massive, and this really speaks to this concern that even as mortgage rates go to the highest levels in 16 years, you're seeing 7% rates being cited, 6.8% average rates on that mortgage level. Yes, you're getting some softness in the purchasing market, but on the rent side, that forces more people to actually rent rather than own, and that's what you're seeing. The stickiness of that feeding into CPI is going to be persistent.
But the Fed's going to pause.
Thank you.
I haven't.
Well, no.
How many times did that come up? The Fed's going to pause.
Well, and this. Well, hold on a second, because there is this other argument.
Hold on for more than a second.
Paul Krugman actually putting out a Twitter thread echoing what Lael Brainerd was saying, and I think this is important. How much emphasis will there be on the ambiguity of lag time, of how long it takes for some of the tightening that we've already seen to make its way into the financial system, and into the economy, I should say. This is going to be the pushback, not necessarily that, yes, you can pause because CPI is coming in, but we can pause because we have not yet seen the impact of what we've already done.
That was 45. I promised.
Thank you.
Any more?
No, I'm good.
You good? Do you want to go to Conrad?
Sure. Hi, Conrad. How's it going? You want to save me? Conrad DeQuadro, Senior Economic Advisor at Breen Capital. So let's start there. This question of, do you see that as a reasonable argument that the lag time is so significant that it would make sense for the Fed to pause, that the risk of them really causing a huge recession outweighs the risks that the tightening that they've done already is insufficient to combat inflation?
Well, Lisa, I think the question of lags is a very important one. Unfortunately, the Fed didn't consider that on the other end of this. When we were heading into this inflation problem, we had some signs that inflation was picking up, and they waited too long. They didn't appreciate the lags of their prior accommodative policy. So I think I don't think that means we should ignore the fact that there are lags on the other side as well. But I just think it's too soon to consider that. I think it's very helpful that the Fed has started to consider the stance of policy in terms of real policy rates. And we have it tomorrow. We're going to get CPI, but as of the last CPI report, based on CPI, we have a real policy rate that's still minus 5%. And to me, that is not a tight stance of policy. It's less easy than it was several months ago, with the Fed moving rates higher and with some of the inflation rates on the headline measures coming down a bit, but it's still easy. And so my question is, can we get inflation, 8.5% PPI inflation? In 2019, before we got into all of this, that rate was 1.5%. Is policy tight enough to bring inflation back down to those kind of levels? And is it too soon to start considering lags? And my opinion is that these kind of inflation rates, it is.
Conrad, you're going further than that. You're not asking whether it's tight enough. You're asking whether it's tight at all. Are you saying we're still not restrictive?
I don't think restrictive yet. I can't look at a real policy rate of minus 5% and think that's a restrictive rate. The issue is here, we don't really know where neutral is, and we have different ways of trying to assess it. And I think that looking at real rates is one way to do it. And then the other way is just look at some of the measures that we're seeing that I think are relevant for inflation. So, inflation modeling is extremely difficult. But if we look at some of the things that gave us clues that there was an inflation problem coming, business surveys, for example, last week we had the ISM Services Survey. 68% of firms still seeing rising prices. That was in the low 50s prior prior to COVID. This week we got the NFIB survey. We have 50% of firms that are still raising prices. That was in the 20s prior to COVID. I mean, these are still very, I think, worrying signals on the inflation front, and a sign to me that policy, in a broad sense, hasn't gotten tight. I mean, obviously, with respect to certain sectors, I mean, what has happened in the housing market, I think conditions there have gotten very tight. But more broadly speaking, even if we look at things like financial conditions, measures of financial conditions are not suggesting that we're materially tighter than where we had financial conditions, say, in 2018. And we have a completely different inflationary environment. Now we're trying to get policy tight enough to bring inflation down, not tight enough to maintain price stability. We don't have price stability yet.
This next question's pertinent, I think, to the conversation we're having. I'm going to throw out another concept that is pretty fuzzy and no one really knows where it is, but where do you and the team suppose Naira is?
Well, that's a difficult one, and the only way that we'll really look at Nehru is not in terms of inflation, but in terms of potential wage pressures. I mean, we've always questioned the link between the tightness of the labor market and inflation because it ignores business pricing power and the ability of businesses to pass on higher wages that might come from a tight labor market into inflation. And so I think that the labor market is tight, and we're seeing rising wages. We're seeing, we'll get a measure from the Atlanta Fed that I think is much more useful for wage growth. Their median wage measure will come out this week. Last week we saw still 5% or so increases in average wages. The median measures are running more like 7%. So the labor market is tight and putting upward pressure on wages. And that, I think, it's part of the story, along with things like this PPI report feeding through into inflation, because we still have policy that is not yet tight. And so, and I think we'll get to tight policy. And you're right, John, the Fed is eventually going to pause. We don't know at what point that is. Our feeling is that pausing at around 4.5% is going to look increasingly difficult, given that inflation is probably still going to be pretty elevated in the early part of next year, and they'll be close to 4.5% on the Fed funds rate by the early part of next year. But the other aspect of all of this is, of course, what's going on in financial markets and the conflict between financial stability and inflation fighting. And we've seen it most notably in the UK, where we have this very bizarre situation where markets are expecting the Bank of England to raise rates by 100 basis points at their next meeting, and the bank has resumed QE. So, that is where I think the greater uncertainty is. Does the pause come because the central banks can do it because inflation has come down enough? Or does it come because they're forced to do it because there's financial instability?
And there's two different consequences for markets, without a doubt there. Conrad, thank you. Conrad de Quadros there of Breen Capital. It's even more bizarre than the way he framed it, because, of course, they've started a new bond buying operation over at the Bank of England, just ahead of hiking interest rates maybe by 100 basis points, and somewhere in between, they were meant to start QT.
Which is still on the schedule.
Just get your head around this. It's still on the schedule.
It's impossible. What Conrad was saying is, on the way to tighter policy, what happens if you have a financial stability problem? What is the policy response if you're still trying to get to tighter policy? And basically his argument is you need to keep going, and we're not there yet, but we're getting closer.
Or accept higher inflation.
Yeah, exactly.
Is that the end goal? Something has to give. It's why we called it a trilemma yesterday. You can support growth, you want to try and bring down inflation and preserve financial stability. Can you do all three things? Very difficult to do. Most people conclude by saying, no, you can't. So what gives? You ultimately end up in a place where you have to accept high inflation for longer. And based on the communication we've heard from these guys right now, they don't want to go there.
Well, high inflation for longer is not necessarily a very good thing for the stock market. And that is something that I think people are grappling with as well. If you look at the earnings, strip out monetary policy, what is the negative effect just purely on an inflationary basis?
Amazing to see PPI knock markets the way it just has done. Futures rolling over, going into CPI tomorrow. We're now positive just about 0.1% on the S&P. Up next, Victoria Green of G Squared Private Wealth, Colin Martin at Schwab Center for Financial Research, and Darryl Cronk of Wells Fargo in the next hour, counting you down to the opening bell. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. NATO defense chiefs are meeting in Brussels today to discuss how to better protect critical infrastructure, ramp up weapon production, and maintain support for Ukraine.
Russia knows that the nuclear war cannot be won, must never be fought. And we are, of course, also closely monitoring the Russian nuclear posture. We haven't seen any changes in the nuclear posture of Russia, but we will remain vigilant.
Meanwhile, the U.S. is speeding up shipment of 2 advanced air defense systems to Ukraine in response to President Volodymyr Zelensky's pleas for more weaponry in the fight against Russia. Thailand will tighten its gun control in the wake of a mass shooting that left about 24 preschoolers dead. The Prime Minister says the government will revoke gun licenses if holders are found to be facing mental health issues. The crackdown comes after a former policeman opened fire last week at a daycare center in northeast Thailand, killing 36 people, including 24 children. And in southern Italy, a wheel fell off a giant Boeing cargo jet and plunged to the ground shortly after the aircraft took off. Now, video posted on Twitter, it shows a black plume of smoke suddenly spit out from the 747 Dreamlifter's undercarriage. It did land safely about 11 hours later at a Boeing production facility in Charleston, South Carolina. The footage is the most tracked flight in the world, according to data from Flight Radar 24, with more than 10,000 users following its journey. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? And if we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs. You know, and the ultimate output for a company is share price. You know, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Strong enough to stay, we will never.
Central banks are in a really bad situation. They have started late in raising rates, and now the central banks are doing big steps to catch up with reality, and there is some risk in that. So I now look at monetary policy as an independent risk factor, and I think monetary policy has a way to go.
Axel Weber there speaking with our own Tom Keene down in Washington, D.C. at the IIF meetings. Really a compelling suite of different conversations at a time of incredible change where suddenly people are reassessing the role of monetary policy in a newly inflationary world. Right now, what we are seeing in this newly inflationary world is that any upside surprise when it comes to inflation reads, the latest being PPI, not necessarily considered a major indicator. Still, the knee-jerk response was stocks lower off the highs of the session and bond yields just a slight bit higher. You're seeing a little bit of a retracement back. S&P futures up about 3 to 4 tenths of a percent, 36.13. You're seeing the euro decline versus the dollar, weekend 97.06, and you are seeing crude just soften a little bit after some discussion from OPEC Plus that they expect demand to be lower this year because of just the deceleration. Right now, let's head back down to Washington, D.C. Tom Keene with another fantastic interview.
A nice update there, Lisa. And what's really important, folks, off PPI is how important tomorrow's United States CPI numbers will be for these meetings of the World Bank, the IIF, and the International Monetary Fund. Tomorrow will come from the offices of the International Monetary Fund with some important interviews. Right now, we go all American, and we can do that if you go to the Art Institute of Chicago and go to the very back of the Art Institute, past the Chagall. There is the old trading room of the Chicago Commodity Exchange. It's really something to see from another time and place. That is the CFTC, associated with our Midwest, but much more with what to do with derivative instruments. Kristen Johnson is CFTC Commissioner. Wonderful to have you here with us today. Have you ever visited that spiritual room in the back of the Art Institute?
I have not, and I look forward to it.
As newly minted commissioner, you must go to the Art Institute and go to the back, and there is part of my family's past.
Wow, I'm headed to Chicago in November.
You'll
I'll
have to see it. Let's add to your list now the discussion everybody wants to have, which is Bitcoin. And I refuse to believe this is a sophomore turf war between Kristen Johnson and my good friend Gary Gensler. How can you two get along on what to do with Bitcoin and not make it a silly turf war?
Oh, this is a great question, and not just a great one, a necessary one. To be honest, in the current onset of the current crypto winter, $2 trillion asset sell-off, what comes sharply into focus from my perspective is institutional investors and retail investors. Starting with the latter, in fact, what we could think carefully about is the reality that retail investors have suffered significant losses in light of the onset of this crypto winter. Something else I'd share is if we couple this thinking with the Bank of New York's announcement yesterday. This is Alexander Hamilton's bank, founded as one of the oldest in the history of our nation, now acknowledging that it will, on its platform, service not only conventional financial products, but cryptocurrencies, suggesting and signaling that in the near and not so distant future, institutional investors will be investing in this space as well.
And what's good about this, folks, is they kept from Commissioner Johnson my thoughts on Bitcoin, and we're not going there right now. There's a guy, used to work at JP Morgan, and there's this guy up on the 100th floor named Diamond who's going both ways on Bitcoin. He's saying this is a fraud, and excuse me, Jamie, but something like that. And the other thing is we need to learn about this and do about it. How can CFTC do better than SEC at helping banks on this is a fraud versus this is what we need to do to move forward?
Let me explain what the CFTC is already doing.
What are you doing right now?
In our remit, we are enforcing to the fullest extent of our authority to ensure against fraud, market manipulation, any types of abuse to retail customers who are heavily engaged, as I mentioned, in this market. So that includes first of their kind lawsuits for pump and dump schemes over the last several months, first of their kind Bitcoin or cryptocurrency asset management fund scams against retail investors, and very, very recently, a first of its kind
I saw that.
suit against a decentralized autonomous organization.
This is so important. With Bitcoin 60,000 down to 20,000 as well. The little guy, and I've seen this, folks, generational, they fervently believe in Bitcoin. Are they believing in a derivative instrument, the province of the CFTC, or are they believing maybe in a financial asset under SEC 34 and 36, I think? Is it an SEC province thing, or is it a derivative thing of CFTC?
Your question about whether or not the Securities Act Section 2A1 definition of a security
Put me right in my place on that. Let's continue on Section A21B. Go.
So essentially what we're asking is what qualifies as a security. And in fact, there are two bipartisan bills currently pending in Congress that are working diligently, Senate staffers working diligently to capture an answer to this question. It's a wonderful question. Regulation in our nation in 1946.
Why can't you two get, I'm going to interrupt, why can't you two get along? Why can't the SEC and the CFTC both work on this, which I dubious thing, 60,000 down to 20,000?
I'm going to say we better get along. For the sake of those investors that I referenced earlier, there is a path, and we've walked that path before.
Have you spoken to Mr. Gensler recently about this?
I have had the great opportunity to engage with his office, with him, with other commissioners at the SEC. I think we are all in agreement and on one accord that we want to protect market integrity and protect the customers who are engaged in investing.
You came with an entourage of 20 people, so typical of CFTC. And someone in your entourage said, don't ask her about the politicians. So let's talk about the politicians.
Let's talk about the
politicians. Are they in the back seat of all the rich guys doing Bitcoin? These gazillion, they used to have $40 gazillion, and now they have $8 gazillion. The 8 gazillionaires that are doing Bitcoin, are they buying off the American politicians?
I can only tell you what I know, which is chairwoman of the Senate Ag Committee, Debbie Stabenow. I'm a native Michigander, so we are neighbors in many respects. I believe that she is deeply engaged in expanding the remit of the CFTC over spot market transactions for the purpose of ensuring that a regulatory gap that exists right now is closed.
I got 30 seconds. What happens to the retail investors if Bitcoin breaks support 19,000 and goes down to 16 or 15 or 12? What's the ramifications of that?
The ramifications are significant because those investors are the most critical, in my humble opinion, in our markets. And our most sacred task is to ensure the protection of those investors and the integrity of our markets. So I am diligently committed, whatever we have to do.
Commissioner, I'm exhausted, Lisa. Commissioner, thank you so much. Kristen Johnson of the CFTC there on Section 12, Item 2.
2A1, Securities Act, 1933.
It's very 2A1, Lisa.
Tom, wonderful interview. Thank you so much, and great recitation there of the different provisions and the different subsets. Coming up on Balance of Power on Bloomberg TV and Radio, Kay Bailey Hutchinson, former U.S. ambassador to NATO, to break down some of what's happening internationally in markets. We are seeing a bit of a retracement from earlier gains, but still trying to recoup after yesterday's brutal session in stocks. This is Bloomberg.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
For a young person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
Trying to bounce back from 5 days of losses on the S&P and a new low for 2022. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. Next up, CPI.
As we head into CPI this week.
We have a big release this week, CPI.
This is a very, very important data print.
The Fed has been very explicit. Until we see concrete signs of inflation peaking,
they are going to be tone deaf to slowing in the economy. If we have an upside surprise, it could reinforce the resolve of the Fed to over-tighten.
That's the risk. We could get another 75 basis points.
But if we have a downside surprise, one data point is not going to sway them.
The markets have been looking for any window of change and pivot, and I just don't think it's there.
There's no pivot. The Fed has got to keep going.
It's all about the Fed. It's all about central banks.
The difficulty of balancing growth, inflation, and financial stability.
Certainly, we'll be watching that CPI release.
That CPI release coming tomorrow morning. Joining us now is G Square's Victoria Green, Colin Martin and Charles Schwab. Victoria, first to you. PPI coming in hot. What are you and the team looking for tomorrow morning?
I mean, I don't think that bodes well for 8.1 or a 7 print. I think that means it's going to come in high. I think housing is going to be an issue that may come in stronger, and core CPI continues to grow mostly because of the housing problem. So looking forward, PPI does not bode well for a good print tomorrow.
Colin, you agree?
I do agree with today's, hotter than expected PPI. It doesn't bode well for CPI tomorrow. What we're looking at is less about those year-over-year numbers and more about the month-over-month. And when you look at core CPI, it's still coming in hot on an annualized basis. So I think we hear a lot of concerns about a potential Fed pivot or lack thereof. I think we can retire that. We know it's not coming. The question now is, how long does this high inflation persist? The Fed needs to see concrete evidence that it's going to start coming down. And while we're seeing some signs, today's PPI report doesn't help. And if we see a higher than expected core CPI number tomorrow, that's a risk that the Fed will not just continue to be aggressive, but be maybe aggressive longer than people are expecting.
So they keep hiking. This is what Bob Michael at JP Morgan Asset Management had to say to the team here at Bloomberg. When the central bank steps on the brakes, something goes through the windshield. The cost of financing has gone up. It will create tension in the system. I put that to Mohamed El-Erian yesterday, who said going through the windshield right now is the economy. It was the financial system as well. Colin, can you give me your view on that? What is going through the windshield right now?
Sure, that's a risk we see. We phrase it a different way. We say when the Fed hikes, things break. And, frankly, we haven't started to see too many things break just yet. Yes, obviously stock prices are down. When we look at things like the credit markets, they are holding up better than we would expect them to hold up. And that's where we see a key risk right now. When you look at the rise in borrowing costs, what that means for corporations, rising input costs, rising labor costs with wages continue to grow, those are huge key risks for the credit markets. When you look at spreads, however, they're kind of still hanging in there. And when you look at a, say, 5.25% spread for high yield bonds, when we look at previous peaks of, 8% plus during periods of market volatility, slower economic growth, we think that's a key risk. And even though we've seen a modest uptick in high yield spreads lately, that's something that we're focusing on going forward, and we think we'll see those spreads rise and high-yield bond prices fall.
There's a ton of tightening in the pipeline. We had a new low for 2022 in yesterday's session on the S&P, 55.68 on the S&P 500. You know the story, Victoria. There's people just itching to buy this still. They just want to get in there, get away from cash and start buying stocks again. They're waiting for that Fed pivot to, flash the green light and say, go, go, go. You're pushing back against that, aren't you?
Yeah, I don't really see it until the 3,400 level. I think you're still early. I think everybody is hoping for this pivot, but the pivot is dead. We say long live rate hikes because that's what's coming. You got 75, 50, probably 25. I mean, the concern is the lag in the economy. Typically, unemployment doesn't start going up for another 12 months. We had that weird JOLTS reading, not weird, but a very, very big fall in JOLTS. So we're seeing the effects, and the problem is the delayed effects when they go this hard, this fast, tends to make it very hard to make a soft landing. And when we talk about credit spreads and what's happening in the markets, it's just not there yet. You don't have your capitulation. You are fighting a very hawkish Fed. Everybody's a little bit excited about what's happening in the UK just because maybe that liquidity problem there starts to bleed in here. And we've already said the only two things that will stop the Fed is liquidity issues or the unemployment rising. And we haven't seen either one of those yet in the US, but we have seen a little bit bleeding in the UK, John. And I'm sure you're aware, the 3 days and what's happening over there. I mean, the only good thing that came of that is the memes, because that's been mocked. You can't really put people on the clock. It creates this chaos. So I do applaud slightly the BOE in the UK for making the US look a little bit more functional these days, so I'll take it.
Governor Bailey making it pretty clear. You've got 3 days.
We've announced that we will be out by the end of this week. We think the rebalancing must be done. And my message to the funds involved and all the firms involved in managing those funds, you've got 3 days left now. You've got to get this done. Because, again, part of the essence, I think, of a financial stability intervention is that it is clearly temporary.
One report calling that timeline into question, the FT reporting the BOE signaled to bankers earlier this week it could extend purchases past Friday. A spokesperson for the central bank pushing back, saying temporary and targeted purchases of gilts will end on October 14th. It has been made absolutely clear in contact with the banks at senior levels. Guy Johnson out of London joins us now for more. Guy, I think all of our heads are just spinning.
Absolutely. So it's worth probably taking a step back and thinking about what is happening here. Clearly, the Bank of England wanted to disabuse the market of any idea that there is going to be any kind of extension. That FT report probably was the catalyst for that. Does make you that was a very emphatic statement, wasn't it, from the governor? Makes you wonder kind of what information they are getting from the market. The plan that they've put in place in some ways hasn't been effective, and there are a number of reasons for that. In some ways, it's very different to QE. They are not price agnostic. The other thing is, John, that a lot of this is about the unwinding of swaps. So you need the collateral for the swaps, which then obviously has a counterparty which you've got to deal with, and you can settle the swap with them, but you can't settle the swap with anybody else. So you have to put yourself in a position where you're selling gilts in order to raise the collateral, in order to make the call on those swaps. So the bank can't solve the swap problem directly, but it's trying its best, and it's going to be interesting to see next week if we get the repo operation functioning via the commercial banks, whether or not that's going to do any better. But at the moment, I'm surprised that the Bank of England is pushing as hard as it is on this one. I think a lot of people are surprised that the Bank of England is pushing on this one as hard as it is. We've still got to wait until we get the report from the Office of Budget Responsibility here in the UK, and we've also got to get, obviously, to that next rate hike from the Bank of England. So there's a huge kind of period of uncertainty. So, John, yeah, the price action this morning was extraordinary. I think that was because the bank basically said that FT report, there's nothing doing there.
It's nuts right now. The 10-year up 17 basis points, the 460, the 30-year yield up 27 basis points, north of 5%. These are the levels that we were looking at back at the end of September, and in some cases, in some maturities, we're through them. Guy, do you get the sense, and I understand this is difficult to do, but this is the challenge at the moment, do you get the sense from them that they're worried about contributing to perceived fiscal dominance, and that's why they're pushing back so hard here?
Absolutely, John, absolutely. You listen to what Hugh Pill has been saying up in Glasgow today, the chief economist. He is making it very clear that he thinks currently the fiscal position is going to be inflationary. They need to lean in on that. They are going to raise rates aggressively to deal with that. They want to make sure, and this is why they've structured this program in the way that they've structured it, is that this is not QE, and you should not perceive it as QE. Now, I think once, again, you take a step back, it looks awfully like QE, but they're trying to find ways of making it not look like QE. The way they've structured it, they are not price agnostic. They don't have to take your bid. They are making it very clear that this is not QE. So I think that understanding is real, and I think that may be contributing to their desire to get out of this on time. Now, whether or not that is the right call, I don't know. But the governor sounded very emphatic there, which does slightly make me wonder as well whether he knows something else as to what is happening in the market at the moment, just how many funds are affected by this problem.
They're not backing away. The government's not backing away either. Guy Johnson, what a month lined up in the United Kingdom. So October 14th, the gilt market operation is set to end on Friday. End of the month on Halloween, get a fiscal announcement from the government, and you get some forecasts from the OBR as well. Then on November 3rd, you get a Bank of England rate decision. Colin Martin, I wonder if it plays out that way, or whether we have to get a decision before that.
We could. I think the key point right now is uncertainty. And as Guy was talking about, there's a fine line between QE, QT, and really just helping provide market stability. I think things happening in between meetings certainly can't be ruled out, but it's very fluid right now. The way we're approaching it right now on the domestic side, on the U.S. side, is that it just throws a wrench in our investment outlook and really the global investment outlook. When you look across the globe at global growth concerns, sky-high inflation everywhere, and now other central banks needing to intervene in their markets, it just shows that there are these issues all over the place, and everyone's focusing on fixing something in their territory, in their region. So right now, anything can happen. When we look at it with the Fed, obviously a big question is, well, what's happening with the dollar? What impact does that have globally? They've told us that they're focused on inflation right now, and as we saw this morning, and as we'll see with tomorrow's CPI report, we really view that as a key driver along with the U.S. labor market.
Victoria, you know the question that I've heard a few times on this side of the pond, it's why do I care? Why do I care what's happening in the gilt market? What does it matter to me and my allocations here in the United States? Should they care?
Yes, they should. I mean, it does matter. The UK is a very large market, both on the financial markets as well as what they provide globally. So the UK and the EU, we're not immune. If they, catch a cold, we're going to sneeze too. And so you have to look at that and realize it is all interconnected. And when you have a currency crisis or a bond market crisis, it tends to affect every other market as well. And so we can't be agnostic to what's happening over there. And you have to also say, how much is this going to be something that happens in the US? How much do we have to be concerned about liquidity drying up and having some sort of lockup in the fixed income markets? Obviously, treasury markets have still remained very liquid, and relative to the rest of the world, they're hanging in their yield-wise. Obviously, the 2-year at 4.3 is extremely expensive, and we have 40 basis points inversion. So you have to say recession, and even Biden tacitly understanding that a recession is coming. When the president realizes and says out loud and says the words, the quiet part out loud, that yes, we may have a soft recession, that tends to mean that the data is very poor. So it's going to matter, you know, and look at what Yellen said yesterday. The US dollar is probably going to continue to go up because of our policies here. We have a relatively strong economy. We have a very strong currency. And if you look at what's happening with sterling and with the yen, I mean, the yen's trading back to where they did intervention in '98. So what's going to happen over there? So I think you have to realize it is all interconnected and it does matter.
Victoria Green, Colin Martin, sticking with us. Coming up on this program, the president dropping the R word.
I don't think there will be a recession. If it is, it'll be a very slight recession. That is, we'll move down slightly.
AMH right here in New York City. That conversation up next.
The satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
I don't think there will be a recession. If it is, it'll be a very slight recession. That is, we'll move down slightly. Look, think about what's happened. We have done more. We're in a better position than any other major country in the world.
The president acknowledging the risk of recession and downplaying the risk of recession at the same time. Secretary Yellen promoting the strength of the economy, as you might expect, saying this: the US is doing very well. We have to continue to have a very resilient economy, an economy that's slowing, but something we expected fully after a very strong recovery. I remain encouraged. The Secretary of the Treasury speaking to CNBC just yesterday. AMH with us right here in New York City. Anne-Marie, I have to say the story that they're selling going into the midterms gets a little bit harder to sell.
Yeah, it does, especially after you see what's happening with producer prices just today. What the president is saying is that he's downplaying this risk of a recession. But what president is going to forecast a recession 4 weeks before the midterm elections? One thing they are leaning into, Jonathan, is the robust job market and the labor market. 3.5% unemployment rate. What they continuously say is that this administration added 10 million jobs. Now, Mike McKee would say 10 million jobs were recovered because the economy was completely battered. But this is what you're going to lean into. The issue is, you and I do not feel our neighbor getting a new job. What we do feel is gas prices going up, food prices going up, and our rent prices going up. And just for a moment, can we quickly juxtapose this position? Just a few blocks from the White House, you have the IMF saying the worst is yet to come, and that in 2023, everyone will feel like they're living in a recession.
Politically, that's not a message you want to send right now, and we know how the international story is bleeding into the domestic one, with Saudi Arabia very much in focus for this administration. Take a listen to what the president had to say.
There's going to be some consequences for what they've done with Russia.
What kind of consequences? Menendez says suspend all arms sales. Is that something you'd consider?
I'm not going to get into what I'd consider and what I have in mind, but there will be consequences.
There are many reasons, AMH, to think about reassessing the relationship with Saudi Arabia. It's curious to me that this was the line in the sand for so many people.
Yeah, it is interesting, especially given the fact that before the president made this historic trip, many, especially on his own party, the progressives in his party, were saying you should not go there based on human rights concerns. Now they are looking at reassessing it after an OPEC decision. And in this interview the president gave to CNN, he also talked about the fact that he wanted to make it clear. He wanted to set the record straight. He was not going to the kingdom because of oil. Yet, given the fact that Saudi Arabia, the de facto leader of OPEC, cut production, now they are thinking of recalibrating it. But if the trip wasn't about oil, why are you recalibrating the relationship? The fact of the matter is there are two things the administration could do or Congress can do, because right now, Jonathan, what you're hearing from both sides of the aisle is that they are very upset with Riyadh. No OPEC is coming back. This could potentially mean, if the president were to sign it and this legislation is revised and passed off on a bicameral basis, that the U.S. government could go after these producing countries for manipulating the market. And then, of course, there's things like arms sales.
Yet they want to manipulate the market at the same time. I can't get my head around it.
Oil price caps.
What's that?
These are things
that's managing the market.
This is what producers will tell you back. This is what they will. This is their argument.
Anne-Marie, down in D.C., up in New York this morning. Anne-Marie, thank you. Victoria Green, Colin Martin back with us. Victoria, let's start here, just with a question first. Do you get the sense what is happening in the energy market is a one-off shock or a big permanent adjustment that we need to adjust to?
I think it's going to be a bit permanent, especially with what's happening with Russia. So, you know, part of the Saudi cuts were really a headline cut because they really only had about a million barrels they're cutting because they were underproducing, and they were concerned on demand. It certainly was a slap in the face to the Biden administration. I think they're going to have to release the SPR reserves, even though we're only at 416. You know, we're down to the 1980s levels. I think because of what's happening in Russia, we have new sanctions taking place, and what most people don't understand is that the sanctions taking place in November is about insuring the cargoes, and the insurance for cargoes of oil, like something ridiculous, like 95% of it comes from the UK and from Europe. So if you can't insure the cargo, the ships aren't going to run. And so because of those sanctions, I think the last time that Russia can ship oil out to get to Asia, which is where they've been selling, is to Asia and India, is something in late October because of the time it takes to transit the Suez Canal. So you're seeing suddenly the Russian market may completely shut down if they cannot ship on cargo ships that are insured, because nobody wants to insure it from the UK and Europe. So I think this market is adjusting higher. You know, Saudi Arabia does seem to be aligning a little bit more with Russia, but you still have wild cards. You have Iran that obviously could come on board. They have a lot of production. They have a lot of floating storage. And then right now, the U.S. has become a net exporter of crude oil and crude oil products. And so it has been net beneficial to the U.S. producers. It's not great for the U.S. consumer. You know, we're up 30 cents in gasoline prices over the last 30 days. You know, oil prices back at 90, up about 13% here in October. So yeah, rising gas prices going into an election is not good for anybody's political party.
Colin, I worry about the policymakers' approach to this, the time horizon they have. The administration is focused overwhelmingly on the midterms. The Europeans are focused overwhelmingly on getting through winter. I get it. That's the issue right in front of their face right now. But when you think about things the way Victoria just framed them, not as a one-off shock, not as one winter, one war, but as something more permanent, you have to calibrate policy for that. And exhausting the SPR, going into something that is a permanent adjustment for the world economy, taking out Russian barrels. Colin, mistakes happen. And I have to say that I think you can take this beyond commodities. I think you can take it to the equity market as well. There are still a lot of people looking at this equity market, treating stocks and this market regime as just an aberration, that ultimately we return to the previous regime at some point in the next 12 months. Rates are going back down, tech will rip, it's the old playbook, it's coming out soon. Colin, do you push back against all two of those things, both?
Well, on the energy front and the length of time, the permanence, I think one thing that's important, and this impacts at least policy from a Fed standpoint, if we have a prolonged period of elevated oil prices and elevated gas prices, we know that if the prices don't change, that doesn't impact the rate of inflation, right? But if the price is high, that has an impact if we're going into that dreaded R word, the recession. If growth does slow and we start to see the cost of borrowing rise, we start to see wage growth slow, and consumers, as Victoria mentioned, are still kind of struggling at the pump, paying more for their electricity bills, gas, things like that, that has an impact even if the rate of change hasn't changed or is flat over the next year or so from a gas standpoint. Now, as it relates to the markets, I'll leave our colleagues at Schwab, like Liz Ann Saunders, to talk about the equity markets. What we're seeing in terms of what this means from a policy standpoint over the next few months is ultimately we think that there's going to be a slowdown. We're seeing an inverted yield curve at some of its deepest and most inverted points in a long time. We don't expect a cut necessarily in the near term, mainly because most Fed officials have told us that's not their plan. But at the end of the day, we do expect ramifications from everything that's going on, both domestically and abroad. We do expect growth to slow from here on out. And there's a negative impact of these Fed rate hikes, not just to fight inflation, but it makes the cost of borrowing more expensive. So when we look ahead 6 months, 12 months, how the consumer's feeling, they might not be feeling as good in 6 or 12 months as they do right now.
Hey, Colin. Good to catch up, sir, as always. Colin Martin there alongside Victoria Green. Victoria, thanks for being with us here in New York. Your equity market, the S&P futures were up by about 1%. They're now almost unchanged, up about 0.1%, coming off the back of PPI numbers from about 50 minutes ago, coming in just a little bit hotter than expected, anticipating now maybe the same thing from CPI. Equities fade, going into that print and going into the market open, 7 minutes away from the opening bell. Up next, the morning calls, and later, Wells Fargo's Darryl Crum, staying defensive to weather a looming US recession. Darryl joins us around the opening bell. That conversation coming right up.
More activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Away from the opening bell in New York City, futures fading going into the cash open. We're up by a little more than 1/10% on the S&P. On the Nasdaq, up by 1/10% also. In yesterday's session, new lows for 2022 in the equity market. At the front end of the Treasury market, new highs on a 2-year yield. In the gilt market, new highs at the long end of the bond market. Your 10-year is up by 16 basis points. Your 30-year up by around about 27. Bit of tension returning to that bond market in the last couple of days. That's the price action. Here's your morning calls. Your first call from Morgan Stanley, downgrading Stanley Black & Decker to equal weight, expecting weaker demand as consumers cut back on spending. Gordon Haskett upgrading Lyft to buy, highlighting the stock's favourable risk-reward and overly negative market sentiment. That stock is up by 2.6%. And finally, UBS upgrading Norwegian Cruise Line to a buy, seeing a notable increase in bookings ahead of earnings next week. That's three of your morning calls. Up next, defence remains the best offence. That's the message from Wells Fargo's Darryl Cronk. He joins us at the opening value. Cash open. Up next.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Seconds away from the opening bell in New York City this morning. Good morning to you. 5-day losing streak on the S&P. Can we break it, snap it in today's session? We're positive by a little more than 1/10% on the S&P. On the Nasdaq 100 up around about 0.2%. The gains fade though going into the cash open following a hotter than expected PPI report. Going into CPI tomorrow, switch up the board and get to the bond market. Yields shaping up as follows on a 10-year in America. Yields unchanged. Your yield just short of 4% at 396, 395, 55. The euro going nowhere, 97 handle. Euro dollar at 97. I am still not used to saying that. 0.9704 on euro dollar. Crude backing away from a big rally last week. We're down by 1.4%, $88 and around about 10 cents. With the open, Let's get you some movers. Here's Abby.
Well, John, we do, of course, have earnings season kicking off this week, and ahead of the big banks this morning, PepsiCo put up a very strong quarter. The stock is popping sharply higher, up 3.4%. They beat by mid-single digits for both the sales and adjusted earnings. Really points to solid demand plus their ability to raise costs. Very important, they raised the outlook, and it's interesting because snack volumes fell, but beverages higher overall. Again, a very strong quarter. Now, take a look at Moderna, up 10.5%. This on the news that their mRNA cancer vaccine development pact has been put in place with Merck. This means that there is life after COVID. Now let's take a look at big tech, because this is interesting. Earlier, all these stocks had been higher by about 0.5% or more. Now Apple's just hanging on by a thread, but you can see Microsoft, Alphabet, Amazon, all a little bit lower. This is, we're talking about this double bear market. I think it's one way to look at it, though, John. The NASDAQ 100 really never left that bear market. At the last high, it was still down about 18% in this strong downtrend, down more than 36%. And the story of the year, rates higher, well, that's hurting this morning again.
Can we snap the losing streak right now? We're struggling to. We're down 0.2% on the S&P, a 6-day losing streak, the longest since September 27th, which was about 2 weeks ago. Can we snap the losing streak, Ed Ludlow, in the tech sector?
Good morning, John. We're down actually 0.1% on the NASDAQ 100. That didn't last long, as you said. We've been higher in futures for most of the morning until we got that PPI print. We know the logic that the Fed will remain aggressive with hikes in order to combat inflation. You look at what some of the market's doing, the chip sector also performing poorly, coming off its worst run of declines in more than 2 weeks. And the index, the Philadelphia Semiconductor Index, coming off its lowest level since September 2020, the NASDAQ coming off its lowest level since July 2020. I think what's really interesting is how big a drag tech has been on this market, particularly in the context of energy. I know you've been talking about energy all morning. If you strip out energy from the S&P 500, you're down 27% year to date. If you include it, you're down 25% year to date. There's no difference when you're based on the weighting. The story of the last 12 hours has been Intel. According to sources, that chip maker will cut thousands of jobs in the face of a PC slowdown. But beyond that, John, we're kind of continuing on with this same narrative, continuing losses in the NASDAQ 100 as the data and the economic front continues to come in.
Ed, thank you. We're going to pick up on that Intel story a little bit later in the hour. Ed Ludlow there breaking down big tech. Equities down about 0.25% on the S&P. Pretty defensive stuff in the first couple of minutes, first 3 minutes of the session. We're up 0.8% on staples. Staples outperforming healthcare. Some relative outperformance there as well. Profit warnings everywhere you look on Wall Street at the moment. They're just building. This from UBS earlier this week, downgrading a number of automakers and saying this: pricing power is at risk. We will shift from undersupply to oversupply in a flattish growth environment next year. Demand destruction is no longer a vague risk. Kaylee has more. Hey, Kaylee.
Hey, John, how quickly the world changes. We went from a world of constrained supply where you had shipping bottlenecks and shortages, which meant we just didn't have enough stuff to meet demand, and therefore companies could charge a whole lot more for the stuff they did have because people were willing to pay up. Now, in an era of higher borrowing costs, tighter monetary policy, slowing growth, that is starting to change, and that is where margin pressure really could come in. To stick on the autos, which UBS was talking about, you can see how come the second quarter of next year, we're expecting serious margin contraction from the levels we've seen in the second quarter of 2022 for the likes of Ford, GM, and Volkswagen. To elaborate on that UBS warning, it's essentially the idea that we're going to end up with oversupply as demand gets destructed, and they think that that will result in profits slumping by about half next year for U.S. and European auto companies, which would basically mean that that inventory to sales ratio that crashed due to supply shortages could start to pick back up, because let's face it, it's a lot more expensive to finance the purchase of a car right now. And this extends well beyond autos. Of course, chips, which Ed was just talking about, is related to it, going from shortage to now a tidal wave, it seems, of demand warnings, but we've seen it showing up in retail too. The likes of Target, Walmart cutting their profits outlooks because they just have a glut of stuff now that people no longer want. The inventory mix is wrong, therefore they have to cut prices, do discounting to bring that inventory down. That's a bad thing for corporate profits, but in theory, John, that's exactly what the Federal Reserve wants to see.
Precisely. In many places, many cases, this is the objective. Not the unintended consequences, the goal. Kelly Lyons, thank you. Darryl Cronk of Wells Fargo bracing for Thursday's inflation print that comes tomorrow morning. CPI core holding the line will be the headline of the week, and will put any remaining Fed pivot talk to bed if it hasn't already. Darryl goes on to say this will continue to pressure yields higher, and any surprise above the expectation will only roil markets even more. Darryl, when is enough enough? 6-day losing streak. We are now all the way back to late November 2020. I mean, just think about that. We've wiped out pretty much all of the post-vaccine gains. Got about that much left to do. Are we close yet?
Not quite yet, John. I think we breached some pretty important technical levels yesterday on the S&P around 3590, which puts 3500 squarely into play now, and maybe even the pre-pandemic levels. The point Kaylee and Ed were making is a great one, which is we have a leadership problem here, right? Tech can't lead, and if history is any guide right now, what's happening is, anytime you go into any kind of a major bear market, so think the tech bear market of 2000, 2001, 2002, tech underperformed for 5 years following that. Think 08, 09 when financials and banks led into the crisis. They never resumed leadership on the other side. So the question is, on the other side of this, can tech actually resume leadership or not? The history doesn't play out well there terribly.
So Darryl, if you're considering potentially a lost decade or a lost 5 years for a big chunk of this equity market, what does that mean for the strategy that's paid off so well over the last 10 years, which is just a market-capped benchmark, the S&P 500?
Yeah, I think that's right, John. I mean, you've got to be much more selective here. You can't just buy the indice. You can't just own the ETF and worry about market cap letting it carry the day for you. I think you've got to look at high-quality earnings. You've got to be defensive in this environment. And so it's really about how you play this. If you think about the margin pressure that lies before us, not behind us, it's going to be fairly extreme with the cost of inputs, labor, commodity prices. When PPI goes up at a faster rate than even what CPI does, and companies don't have pricing availability, that always historically has created margin pressure. And that's exactly what we're seeing right now. And I think we're going to hear in Q3 earnings, the recession talk is the highest level it's been from CEOs and management in a decade, basically. So I think the trouble still lies before us. The good news is bear markets are a function of price and time. We're getting there on price. We're not quite there yet. Time, I think, is a little more questionable. It takes bear markets often a year and a half, a year and 3 quarters to work their way through if history's any guide. We're not that far in yet, so we may have some more time yet to work our way through.
Darryl, President Lagarde speaking right now in Washington, and I'll allow you to try and read between the lines here. She said central banks need to cooperate with each other. Central banks must understand spillovers and spillbacks. Is that a DOJ, here's my message for you, love Christine?
Yeah, well, I think she's right? I mean, there are central banks, everybody is tightening. We know that 90% of the global central banks are tightening. The reality is, what's crazy about this environment is the epicenter seems to be in the developed markets. So obviously in the UK with the BOE, obviously in the JGB market with what's happening with the BOJ. And so that's where it gets concerning, where you have, dollar yen back at 147 this morning. You have gilts, 30-year gilts almost at 5%. So I think Lagarde is trying to take some of the fever out of the markets, if you will, and get them to settle down here, particularly as that UK pension rebalancing has to happen between now and Friday.
I think we've got Mike McKee down in Washington. Good for us. I hope that we can bring him in if he's available, if someone in the control room can tell me. Is he good? Mike McKee. Morning, Mike.
Good morning, John. We've been watching Christine Lagarde this morning. She followed Haruhiko Kuroda, the governor of the Bank of Japan, both of them making the case that central banks must continue with their policies. Obviously, the Japanese are easing, but Christine Lagarde and earlier the Dutch central banker Klaus Knot saying we need more. But they do need to be aware of the fact that everybody is raising rates except for the Japanese, and that could have, as you just noted, spillover effects around the world.
Mike, you just wonder if this is a first step towards convincing the Federal Reserve to back away. Mohamed El-Erian said yesterday we have a global problem. It requires a global solution. How far away from a global solution are we?
Well, I would say we're a long way at this point. It is a lot of central banks who are dealing with local individual mandates. They're supposed to take care of their own economies, and they have to do that. You talk to U.S. Fed officials, and they point out, we know what's going on in the rest of the world, but by law, we're responsible for raising interest rates, essentially, because we've got to bring inflation down under our legal mandate. Everybody's kind of in that boat. I have talked to several central bankers this morning who said they kind of feel sorry for Andrew Bailey and the position that he's in, but there isn't much that Bailey can do differently, because it's either let inflation go, which is against their mandate, or take a chance on the markets. And so this point, he's taking a chance on the markets, and that may become the case for other central banks. We just don't know what's out there. They just can't find a way to centrally coordinate all this. I think what Lagarde was referring to this morning is we talk to each other. We know what each other are doing, but we're not actually working on a coordinated plan.
Mike McKee, thank you, sir. We're going to pick up on this in just a couple of minutes' time. Darryl Cronk, I just want to get a final word out to you, if I can, sir. The approach for decades has been our currency, your problem. Are we at that kind of tipping point, close to it, where it starts to become our problem too?
It could. Obviously, trade-weighted dollar up 20%. I think what's happening right now is the Fed may be underestimating the strength of the dollar and the impact it's having around the globe around dollar shortage and tightening financial conditions. In essence, John, I think what we're saying is the U.S. dollar is putting the world on a margin call right now.
Darryl Cronk there on the latest. It's pretty worrying if that's the case. So I have to say, going to pick up on that in just a moment. Up next, Intel planning thousands of job cuts, adding insult to chipmakers' injury.
You kind of started hearing concerns and actually saw concerns about kind of this consumer-led cyclical downturn within the semiconductor industry. We've seen it across kind of specifically the PC and smartphone markets, where we think could potentially and likely will trickle into other end markets.
That conversation up next.
Politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
you kind of started hearing concerns and actually saw concerns about kind of this consumer-led cyclical downturn within the semiconductor industry. We've seen it across kind of specifically the PC and smartphone markets, where we think could potentially and likely will trickle into other end markets like autos, industrials, and data centers. And there are signs of that in specific areas of semiconductors where that is taking place.
The headwinds continuing to pile up for the chip makers. Intel becoming the latest to feel the pain, planning thousands of job cuts. Bloomberg reporting the layoffs will come this month as the company looks to lower costs amid weakening PC demand. Back with us for more, Ed Ludlow. Hey, Ed.
Hi, John. Sources saying that the focus of the cuts could be in sales and marketing, where those departments get a reduction of around 20%. As you said, on October 27th, Intel has its quarterly earnings report. There is an expectation that we might hear something about this then. Remember, back in July, Pat Gelsinger, the CEO, warned us that sales would be $11 billion lower than previously forecast. There's two things happening, right? The global slowdown for consumer electronics, Intel, the main player in PC processors, but also it's losing market share to rivals like AMD that have made quarters in recent gains. This is a sector where analysts are clawing back earnings expectations going forward, given the change in markets and macro conditions. Really interesting data point, though, on the terminal this morning. Vanda out with a research note saying that retail investors have been piling into the chip sector. Net purchases of $812 million of semi-stocks over the last 5 days, including names like Intel. But this is the latest name in corporate America to respond to changing conditions with reduction in headcount. Severe, but remember, Intel is a unique pain story. The broader cyclical story for chips is one that caught us by surprise.
Ed, thank you, sir. Another sign of weakness, perhaps. The stock is down by about 0.2% in early trading. The broader story, you know it well now. Softer economic data, darker outlooks clouding IMF meetings in D.C. We caught up with Mohamed El-Arian, looking back to 2008.
They're going to be gloomy. Because there's also geopolitical risk on top of that. There's the whole challenge on climate. We mustn't forget that. So this is going to be a reminder a little bit of October 2008, when people gather in Washington and realize we have a global problem that needs a global solution.
Mike McKee, Mohamed's not saying it's going to be 2008, just that it's really gloomy right now. It reminds him of how gloomy it was back then too. How gloomy is it from where you're sitting, Mike?
It's gloomy, but not in the way it was in 2008. I well remember that, when there was a systemic problem, when markets themselves were seizing up around the world. And that's not what's happening right now. Instead, it's inflation and it's growth. And that is something that the central banks have to deal with, but it's not going to bring down the entire financial system. At least that's the view here in Washington as central bankers gather from around the world. The British are in recession, according to the latest GDP data out this morning. The economy contracting, the pound obviously falling at the same time. The Japanese yen has been weakening tremendously as well. The intervention wearing off. Haruhiko Kuroda, the Bank of Japan governor, saying we're still looking at maybe doing that again. And of course, Andrew Bailey giving his 3-day warning to people. But what you're seeing is a whole lot of central banks doing their own thing, attacking the problems in their own way. We're not going to see coordination from the central banks. There'll be cooperation, but they're going to remain tough on inflation. All of the central bankers I've talked to here say they are still focused on inflation. That's their mandate. They're going to keep doing that. The G7, G20 are meeting, but don't expect any kind of communique that suggests that they will be working together as they did in 2009 in London, when Gordon Brown got the IMF and World Bank attendees and the G20 together and got them to agree on some sort of coordinated plans to boost growth. Market turmoil may continue, everybody here says. As I mentioned a little while ago, there's some sympathy for Andrew Bailey. But the real question is going to be, do the markets trade? If the markets can trade, doesn't matter the price, central banks will leave them alone. They've got to focus on inflation. And that is a point that was reinforced by this morning's PPI here in the United States, where we saw core and headline inflation higher than anticipated coming into the month of October. And so we look forward to CPI tomorrow with a little bit of nervousness, but central bankers here saying, John, they're going to stay on track.
Fiscal policymakers as well, Mike. They're in focus too. President Lagarde said fiscal policy must focus on the most vulnerable. Mike, back in the pandemic, we had the fiscal space to do a lot for a lot of people. We have much less space this time around. Do you get a sense that maybe we've got to recalibrate the fiscal effort to help those that are really in need and not try and do too much because the space isn't there in the same it was to do more for many more people?
That's absolutely right. There's no space in the United States to do something like that. Even if you agree we can print the money, there's no political will. It's going to be interesting to see what happens in Europe and what happens in the UK. It's a question of how do they finance it in Europe? Are they willing to do joint Euro bonds? That's a line that the Germans haven't wanted to cross, but maybe they'll be forced to do it. And then, of course, all the ructions about what the UK government is going to do for the people, cutting taxes or offering fiscal support. We'll have to see how that plays out.
Mike McKee, thank you, sir. Down in D.C., Mike with us all week on top of this story. It's getting harder and harder to calibrate the policy response to all of this. CPI coming up tomorrow morning. The S&P 500 higher by 0.2%, or the NASDAQ up by 1/3. With your sector price action, here's Abby.
Hey, John, and one question today, of course, will be whether or not the S&P 500 and these indexes can hang on to those gains to snap a multi-day losing streak. As for sector-wise, more sectors are lower at this time, but we do have some strength for consumer staples, up 1.2%. This, of course, on that Pepsi beat. We also have some breaking news right now that the FDA has okayed Pfizer's Omicron booster eligibility for people 5 years and above. So Pfizer is popping higher right now. It's up about 2%. Moderna, that is true for that company and stock as well. It's popping even more, up 12.7%, also having to do with the Merck eligibility or development for cancer mRNA vaccine. And then as for the down sectors, energy is down, and we also have some of those rate-sensitive sectors down. Energy down with oil, real estate and utilities, not as attractive with yields higher. Now, we've been talking about the possibility of this double bear market for the NASDAQ 100, regardless of how you see it, because again, the index is down almost 40% on the year, that steady downtrend. We have these indexes, it's incredible. In the last 2 months, this is that double bear market. S&P 500 tech index down 22%, the stocks, the chips down 27%. You can see some real weakness here, John. This, of course, as yields have gone higher, pressuring valuation, of course, demand, chips, so many different factors. Overall, very bearish for tech.
That 2-month screen is absolutely brutal, ugly. Abby, thank you. Looking at the gilt market right now, 10-year gilt yields up by 14 basis points to 4.57. On a 30-year gilt yields are up by 24 basis points, back through 5%. Go through the diary the next couple of days. We've got CPI tomorrow morning in America. End of the week, we've got bank earnings from JP Morgan and company. And then for the UK, that gilt market operation set to end at the end of the week. End of the month, we get the fiscal announcement. Start of November 3rd, we get a Bank of England rate decision as well. What a 2-3 weeks we have lined up for you. Up next, your trading diary from New York. This is Bloomberg.
Imagine simply climbing a cable into space. The concept is known as the space elevator. Not only could it significantly change how we leave planet Earth, but it could also completely transform humanity's relationship with space. And there are scientists who think we could have already built it.
We have the material, we have the technology, we have the lasers, we have the climbers, we have all of it. If a private entity wants to build it, or a government, they can build it. It'll change society. We have no clue how colonizing into space, how really spreading out into space will really change our society over the next 50 to 200 years. It'll be completely different.
25 minutes into the session, approaching 26 minutes into the session, trying to avoid a 6-day losing streak on the S&P, just about positive, up 0.2%. On the Nasdaq 100, up 0.4%. The bond market in America just about behaving. The gilt market in the UK not behaving at all. That's the price action. Let's get you to the trading diary. Fed President Neil Kashkari speaking at the top of the hour with Barr and Bowman on deck later today. The Fed's FOMC minutes coming up at 2 Eastern Time. President Biden delivering remarks at 3:30 p.m. U.S. jobless claims and CPI coming up tomorrow morning. And finally, U.S. retail sales and the big banks reporting results on Friday. You'll get earnings from JP Morgan, Morgan Stanley, Citi and Wells Fargo all coming ahead of the opening bell Friday morning. Before we get there, it's CPI Thursday, tomorrow morning. Looking forward to covering that with you. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
For a young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. Welcome to Bloomberg Crypto.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145. and another
Connection
hearing for the
lost.
branch 113A, also 3 times a month. Also, there was a time my father was hospitalized due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010, after staying for almost 1 year in the hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Benegold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Benegold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very